and I just signed up to one that was coming up in the next few weeks. Went along, liked what I heard. Obviously, I was only probably about 21 at that point, and I don't think I was too hard to convince. But anyway.
Well, there's a quick, I want to interject. There's an old saying about the stock market. If you want to make $1 million, you start with two, right?
Yeah, I've heard that one before. That's a good one.
So it's real estate or the stock market. But that's so impressive to hear at a young age. I know, as we often joke, while I'm still in my 20s, I'm going to say is we're both still 20-somethings, but I am continually impressed, man. As you said, you didn't have too much worry about the present. You had a lot of foresight for the future, even from an early age. I don't think many 20-year-olds are considering investment properties. I don't know how many 20-year-olds could spell investment property.
Yeah, I mean, that could have sort of had something to do with the fact that I left school when I was 15. I didn't see it all the way through and graduate. That I sort of had those few years experience working. I don't know. But anyway.
I hope this isn't broadcast to children out there who are going to drop out of school thinking that they can buy an investment. I'm just kidding, Aaron. You are maybe an exception to the rule, but a brilliant one. And I don't know, man, I've said this to you before. I'm glad we have you in the stock market now. You're a powerful mind, and you're helping a lot of other people with the podcast. So
thank you. Keep going careful, you might give me a big head. But yeah, so where was I? So yeah, I signed up. And what I signed up for, I should be a bit more clear. So what I signed up for was, essentially education on how to trade. And that education sort of involved, a great big thick book, a couple of DVDs, and like weekend workshop. So it was about like 2 days long. Mm-hmm. Anyway, I went home, obviously got stuck into the book. I watched the DVDs. Like I put in a fair amount of study. Like I didn't bring it home and put it on the shelf and let it collect dust. I got stuck into it. It was actually really good. It sort of taught me how to, chart, technical analysis. Like I was actually hand charting. So I spent at least probably the first 6 months before I brought a decent piece of like charting software. And I was actually just charting by hand. And I think that was a pretty valuable skill to have, to actually sort of understand like how to actually construct a chart without just having the software do it all for you. You sort of like understand how these tools are actually working, what's going on. So I was plotting, just a pretty standard bar chart or candle chart, and with an indicator over top of it that I use occasionally. Anyway, the method that this company taught was the methods of William Gann, W.D. Gann. And for those who aren't familiar with him, he was sort of considered to be like a Wall Street legend of the early 1900s. I think he passed away around 1950 sort of time. Don't quote me on that though.
Sure.
And his methods were a lot of them were sort of based on ranges repeating and time repeating, and then fractions of those time and ranges. So I studied his methods for probably about 2 years, maybe close to 3 years, pretty intensively. I also read a bunch of his books multiple times, so I got right into it. And anyway, I sort of, by the time I hit 3 years, I was like, okay, well, I opened a $5,000 account like way back, probably about 6 months after I started reading up on trading. And my account, it's gone up a little bit, and then it's come down a little bit, and it's just sort of floated around the opening balance. Like it hasn't moved too far. I haven't lost a great deal of money, and I haven't made much money. So I was sort of like, time's ticking by. I always sort of feel like there's an urgency, and I was like, I need to change something so what I'm doing just isn't working. So yeah, I mean that's pretty much how I got into trading. I don't know if I missed any parts out there.
No, this is good. I want to interject before we get to how the podcast started, because that's the question that's been on my mind. I'm sure everybody else's mind. How'd you arrive at this point? Before we move on, I want to ask about what appealed to you about GAN. I think most people find GAN more in the intermediate part of their trading career. It's interesting to hear somebody who learned about his methods early on in their trading career. Seems a bit daunting. Was it the, I don't want to say artistic balance maybe, but the you don't need to have too much technical understanding of the markets to appreciate maybe a fractal price pattern or an understanding of Fibonacci, to make an analogy, right?
Yeah, to be perfectly honest, I mean, that was just the first thing that I started learning about. So when I went along to the seminar that one time and I signed up for the education and that sort of thing, it was just, that's what they taught. And I just stuck with it. Like, I was always very conscious of not jumping around too much. I didn't want to sort of go from one educator to the other and just sort of spin my wheels. So I just kind of went deeper into that subject because I'd already started getting into it. I just went deeper into it, started learning more and more about him and his methods. And I kind of reached a point where it just seemed a little bit wishy-washy for my liking. I don't know if that's a good way to describe it, but like, it was just a little bit open to interpretation, I think. And I'm not saying that it doesn't work. I'm not one to say any strategy or any particular way of trading doesn't work, because there's always people out there who it works for them, right? I'm just saying, for me, I just wasn't really vibing with it too well. But in saying that, it did give me a good understanding of, you know, ranges, understanding market kind of moves and structure and that sort of thing. Different periods like accumulation, distribution, you know, consolidation, all those sorts of different repeating ranges, all that sort of stuff. Like, I learnt a lot from reading up on GAN, even if it's not how I directly trade today.
Yeah, I mean, that leads into all sorts of questions. Are you live trading now?
Yeah, so I started live trading probably since like about 6 months after I started reading up on the stock market and started like educating myself. I didn't open a brokerage account and then decide to get educated. So I knew that I had no idea what I was doing. I got to get clued up before I put any money into this. So I took that approach. I sort of studied pretty hard for 6 months, and there was a little bit of paper trading in there. I didn't paper trade too much. For me, it wasn't really.
It's hard to have the gravitas of real money, right?
Yeah, exactly. And I sort of struggled with like treating it like real money, even though I'm like, oh, that's a losing trade. That's annoying. But it's like, you just don't fully get it. Even though recently I've been paper trading a new strategy, which I'm sure we'll get into a bit later, and I have found it very useful. But at the time, at the very beginning, I couldn't really find much value in it, to be honest. So I know it works for some early on. It didn't really work for me too early on. So anyway.
It's like you had to build the experience to know what would be different and be cognizant of it. Early on, it just seems like I'm not getting something here, but I'm not able to put my finger on what it is that I'm lacking.
Yeah, totally. That's you pretty much hit the nail on the head. So, yeah, I've been trading. I opened a $5,000 account, and I'd been trading that sort of ever since. And recently, I haven't been taking many live trades, but again, I'm sure we'll get to that a little bit later.
It just sounds like you're in a development cycle. This is something that traders routinely go through. They go through activity cycles and development cycles. You know, sometimes it's best to bunker down, build the strategy, test it, as I know we're getting into more of the quantitative stuff, but it's a pendulum and it swings back and forth and never ceases. Many traders think, I'm going to do a year of development and I'm going to go make $1 million for the rest of my life. And I think it's that constant refining and honing of the process a lot of lazy traders don't want to do, and it's no surprise why they don't succeed. I was actually going to point this out earlier when you were talking about your development on GAN, your research and understanding, building the bar charts manually. I hope all your listeners pick up on the thing you're really doing right is you're developing mastery of a specific subject before moving on. Even if that subject isn't going to be useful to you, or I should say profitable, it'll still be useful. Learning how to learn, learning how to evaluate, learning how to arrive at an actual conclusion instead of it forever being, well, that might be helpful. I'll hang on to it. You kind of need that finite, nail it down kind of nature. And I think you've succeeded in that from what I've seen. So,
I mean, I don't feel like I don't, definitely can't say I mastered Gann, but there's definitely aspects of what I learnt from reading up on his material that I still use. So I don't use like the full package, of course. It's my approach is much different now, but there are certain things which stick with me,
I feel that same way about Elliott Wave. I always say I'm so glad I learned Elliott Wave, and I'm so glad I don't trade Elliott Wave. So I'm sure I'm going to inspire some anger from a few Elliottians out there, but I apologize. To each their own. So does that bring us up to when you're starting the podcast, or are there a few more points we want to hit on?
Yeah, so I mean, from there, that probably does lead into the podcast. So obviously I've sort of like 3 years into this journey, and I'm not seeing huge success, and I'm not seeing massive failure either, unless you consider not making money as failure, but at least I wasn't losing heaps. I never blew up any accounts, or touch wood, I haven't yet.
There's still many years in your trading career, my friend. And that's an okay thing, by the way. I'm not ragging on Aaron here. I'm giving him a hard time that he's going to blow up an account. The smartest thing, I think I may have mentioned this in my interview, I put the minimum in. So even when I did blow up an account, it's not the end of the world. It's the most modest loss that you can take. So good on you for being patient. I mean, that's another thing I'd pat you on the back for. Anyway, continue. Podcast.
Yeah, so, I mean, my passion for trading sort of gradually got stronger, and I was just like, there's no point doing this half-ass. Like, if I want to actually make trade and make some serious money doing this, then I need to, give it my full, well, not say full attention, but I need to give it the attention it deserves. So I was sort of like, just in like my circle, none of my friends were into trading. None of my family was into it. I just didn't know any traders. I had no one who I could speak to about trading who understood it. So I felt like, I've used this analogy, you've probably heard this 10 times, Zach, when I've been speaking to others, but like, if you want to be a mechanic, right, you hang around with people who talk about cars, work on cars, fix cars, you know what I mean? Mm-hmm. I wanted to be a trader, yet I didn't know a single trader. So there was kind of a disconnect there, and I felt like that was partly my issue, is I couldn't learn from anyone who was more experienced. Mm-hmm. So I've always been a fan of podcasts. I always listen to podcasts, and I was just like, this would be really cool. I'd love to speak. It could be a really good platform that would allow me to speak with other traders. And, I can ask them a bunch of questions. It was sort of a podcast that I was looking for, that I would like to listen to myself, but I couldn't really find one that sort of really grabbed my attention too much. Mm-hmm. So I was just like, well, I'll create it myself. And I have the graphic and web design knowledge, which I briefly mentioned earlier. To sort of, put together a website, just jumped online. If you want to learn anything, you can just jump online these days, looked up how to set up a podcast, and just read up on it, brought a bunch of equipment, and then just started, emailing some traders. So
I got to ask, and I'm such an old fuddy-duddy here, why podcasts as a medium, not to challenge you, but like in such a visual profession, so many charts, to do a podcast seems almost backwards, but you've had such great success. I mean, it's definitely quality of the people you've brought on. I'm kidding. As well as the quality of the interviews, man. I can't tell you how many people I've spoken to who have, and so I will, on behalf of all listeners, thank you for what you're doing and for putting it out there, man. I hope you know that. And probably not the only time I'm going to thank you on this, man, on behalf of everybody. Go ahead.
Yeah, that's a really good question, and it was something that kind of did run through my mind. Mm-hmm. It did run through my mind when I was initially, sort of scheming. But I mean, podcasts, you can listen to it anywhere. You know what I mean? Where a video, you've got to be sitting down, and it takes your attention. You know what I mean? Like you can't be. I mean, a lot of people listen to podcasts at the gym, driving to work. I don't know, a bunch of different places. Whereas if you're watching a video, you can't really be doing anything else. And
right.
I know,
so accessible. Yeah.
Yeah. So yeah, accessible. That's a great word. It was. Yeah, the video, and I mean, what was I going to put on the video? I mean, I'd have to ask the guests to sort of share their screen kind of thing. And I mean, a lot of it, when we talk about setups and that kind of thing, would be nice if we could have some visuals. And that's maybe something I'll consider, sort of further down the track, is how we can maybe sort of work that in. But like for the part where they're sort of discussing their journey and that sort of thing, like we can get away with it on a podcast, I feel. So
I love that you can hear so much emotion and experience and sometimes burden in traders' voices. You know what I mean? I'm talking to a trader, and you feel like you're talking, somebody with 1,000-yard stare. And I know you're really good at this. You pick up on the words that people choose to describe certain topics. I just know you're really good at pulling the quotes from each of the the interviews. It's always impressed me when it was after my interview or something, and I was like, I said that? And I was like, man, Aaron is smart. He's paying attention to me more than I'm paying attention to me. But it makes it really cool to read through some of the interviews and find those quotes and hear the interviewee say it. So definitely, I mean, I can appreciate the audio is really the most important part of connecting, and putting a voice, a persona to a name or some charts. It's all very dry and distant, and the voice is so, personal and connecting.
Yeah, and I mean, podcasting, it's just so much more engaging than reading a blog article, right? So, I mean, I could interview someone by email. Mm-hmm. You know what I mean? I could just turn that into a blog post, like a written blog post. It's not that I'm sure it would be a good read still, but
you could post it on your GeoCities page back in 1999.
I can't say I know what that is, but
wow. Okay, the age disparity is real. How old are you, Aaron? I don't know if you've ever mentioned this on the podcast.
Yeah, I'm 24. So,
God, geez,
25
kids these days, man.
25 in December. So where'd that come from? 25 in September.
You need to review your notes about your birthday. I'm just.
I try to forget it. To be honest.
It's all good, dude. I know people are probably impressed and a bit daunted listening to you. When I first met you, I was like, man, this guy's going to be in his 30s or so. Oh, he's 5 years younger than me. Great. I've got some guys listening. 19, 20, 21. Like I was emailing a guy last night who's been listening to the podcast and reached out. And he was only 21, and I was like, well done, man. Like it's a great age to be getting into it. Do you remember the, not to put you on the spot here, but the email that you got from the father-son duo who had listened to your podcast while driving cross country?
Yeah, that was really cool one to receive. Actually, I wish I could give them a shout out so I could mention their name. But father and son dropped me a line to mention that they'd been on a road trip across the state somewhere. I can't remember where it was, but they were on a road trip. It was about 10 hours, and they smashed out about 10 episodes of the podcast. So I was like, wow, congrats for putting up with me for that long.
Well, and having something cool to discuss and kind of bond over. I just think it's neat that you're giving people experiences like far beyond probably what you expected when you started this. And this is another thing. Sorry, I'm giving you a bunch of praise here, but man, you started this in January of 2015. What? I don't know how else to say it other than I'm brutally impressed, man. You've had a tremendous following, and it's cool to see it grow. And I'm thrilled to hear from people still to this day, 3 months after my interview. I'm sure you hear from every single day who have found some value in this. So
Yeah. Well, I mean, I definitely like to connect with anyone listening. So, I mean, I'll just mention it right
careful
now.
what you ask for, my friend. I learned from being on episode 11 where I offered a free consult, and in the best of ways, I was overwhelmed. But it's cool to see such a response. There's no other way to put it. And I know you're genuine in offering to reach out to people, or have people reach out to you.
Yeah. So, I mean, if anyone wants to drop me a line at any point, just shoot me an email. My email address is just aaron@chatwithtraders.com. Otherwise, just hit me up on Twitter @chatwithtraders. But yeah, that's a bit of a side note. So where were we?
So I was going to ask you actually about swing trading versus day trading, because when I first met you, so many months ago, I'm kidding, back in January, you were predominantly a swing trader, right?
Yeah, absolutely. So I've always swing traded since I first started reading up and learning about how to trade, how to become a trader. Swing trading was just sort of, again, it was just the first thing that I was introduced to, and I just sort of stuck with it. I always knew about day trading, but I never I never attempted it or bothered to read up on it, because all the material that I had on GAN, and I don't mean to keep bringing up GAN, but it was all swing trading. It was all swing trading. And so it could be anywhere from holding a position to, a couple days to potentially a couple weeks. And I kind of liked that. I kind of liked that approach because, I mean, like a lot of swing traders, I had a job. I was working. I used to do shift work a little bit, but for the most part, I was, working during the day. So I couldn't really watch the market too closely during the day. So with my swing trading, once I sort of started to move away from GAN, like I mentioned, I took some aspects that I really liked from his methods, and just some other things that I'd observed, just some particular setups. And I just tried to refine those a little bit and just get a bit more specific on what I was actually trading. Because with his approach, there's a lot of variables and a lot of different things to take into consideration. I tried to sort of almost dumb it down a little bit and just try and set myself some rules, create like a bit of a trading plan, and say I trade this setup, and this setup looks like, A, B, C, D. And I
realize how smart that is, that you're going through the boot camp before going to war. I think we were joking about this before. Like, most people go to war, get shot a bunch, come back, try and take boot camp, aren't really motivated to go through. It's such a backwards process, and it's so refreshing to hear somebody, especially as a novice in the stock market, so to speak, who's that diligent and disciplined. I mean,
yeah, I mean, I'm not saying that this approach led me to huge success, because it hasn't yet, but it was just an approach that made sense to me at the time I was doing it. So I did that, and I would take these trades, as they came up, as I saw them setting up. I'd take these trades, I'd trade them with a live account. A lot of them would lose. Occasionally I'd get a winning trade. And I'd sort of go back over them. I'd try and see what the differences were, just that usual sort of thing. And try and refine my rules a little bit. But this particular setup, so my swing trading setup, so I try to narrow it down, dumb it down, like I said, and just focus on, one particular setup, which had a couple variables. And this setup sort of didn't come around too often. Like, it wouldn't be strange for me to be out of the market for a couple weeks at a time. And I sort of had the idea that if I want to excel my learning curve, then I need to get more screen time in. And I need to be, sitting out of the market for 3 weeks while I'm still checking it each day, end of day. It's not very exciting. And I feel like it's slowing down my learning process. So that was about the time when we were introduced by Peter Zhang. and you sort of introduced me to VWAP and the VWAP sort of the strategy that you were trading and those sorts of methods. So that kind of led me into intraday trading to kind of fill that gap of having periods where I was out of the market for a few weeks at a time, waiting for a setup to come around.
So that was a great pun with Gap, by the way. I have to comment on that. I'm just kidding.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
You notice also what you're identifying, I just want to point this out, is that you needed more quick response time in your signals. You needed to know if you were right or wrong more than once every 6 weeks.
Yeah.
You know what I mean?
Exactly. Yeah. Like I said, it's just like dragging out that learning process too much. Like I feel like I've, already been doing this for a few years. Let's try and speed things up a bit.
If you're not careful, you're going to be my age, man. You're going to be an old fart at 29. So I'm just kidding.
Yeah, better watch out.
So this is when we started talking. We were speaking more intraday, and this gets you into a bit of quantitative trading, although we're both a bit nascent quantitative traders, right?
Yeah, so this is probably going to lead me on a bit of a tangent here, and I'm not saying that it's right. I'm just saying this is kind of where I'm at in my head right now. And I mean, the more I learn, the more I'm starting to see things like this.
Sure.
So let's say you've got a particular setup or you've got a strategy. Okay, so you can look at a chart and you can say, this is where I would have entered, this is where I would have exited, and that would have been a winning trade, right? Following the rules that you've mentioned in your trading plan, in your setup, that would have resulted in a winning trade right there. But if you were to take that same strategy and that same setup and look at 100 other charts, you're going to see that strategy and that signal, whatever you want to call it, where it's triggered and it would have resulted in a losing trade. So how do you know if there's a genuine edge to that setup if you don't have numbers to put to it? So you don't know how many times that setup is expected to result in a profit, how many times that setup is expected to result in a loss. You have no idea. You know that sometimes it works and sometimes it doesn't. But I'm just very unclear on how you know if there's an edge in that setup.
Mm-hmm.
Does that make sense? I don't know if I explained that very well.
No, I know what you mean. Most traders exist in this like state of unknowing. And then, so it's a commonplace of I've seen great examples of success on the charts in front of me. I've also seen terrible failures. I kind of believe that I'm going to intrinsically find more successes than failures. But if I don't really know with what likelihood I'm going to find a winner or a loser, I can't really calculate a viable risk reward that'll generate profit consistently for me. That state of unknowing is what keeps people from being quantitative traders. They're afraid of, what if I'm wrong? What if I find out I have no edge? But I'd always ask, what if you find out you do have an edge? We talked about this before, the inescapable truth of quantitative trading. You have to know one way or another. If you have an edge, you deserve to be trading with that confidence. And if you don't have an edge, you have to know that right now. You have to find that out as soon as possible to avoid future losses.
Yeah, so that particular, swing trade setup that I kind of mentioned before, that I'd focused in on and just trading that particular setup with a couple variations, like I knew that sometimes resulted in a very nice winning trade, and I knew it also resulted in losses, sometimes. So
sure.
I didn't know without knowing if I was to trade that 100 times, where I would stand at the end of that 100 trades. I don't know if I'd be up or down. You know what I mean?
It's like you're talking about the difference between belief and knowledge. When you believe that something is going to be good, that's fine, right? But if you know it's going to be good, I mean, it's a very different, you operate from a different point of confidence and clarity. You kind of remove the emotion when it's not you're hoping for this to work out because you don't know, but rather you've already asked and answered those questions.
Yeah, so this kind of led me into wanting to learn how to code, and kind of led me in that sort of quantitative direction of trading. So, I mean, still in the very, very early stages of that. And I mean, you were partly responsible for sort of leading me in that direction, just to a certain extent. With
I'll take the credit or the blame, whatever it ends up being.
Like, you sort of introduced me to ThinkScript at least, and we sort of started going through some ThinkScript documentation. I started reading up on the ThinkScript manual on the website.
And just a little context for people who may not know, ThinkScript is a JavaScript derivative used by TD Ameritrade's Thinkorswim. The reason why I thought this would be a good starting point for someone like Aaron is it's free, it's pretty accessible, it's well documented, and I happen to know it inside and out. So I felt like it was a good starting point for us. But I got to be honest, Aaron, I've never seen anybody take to code like you have. And I know you're going to be humble and say, well, I'm still working on it, but I've been very impressed. I gave you the assignment, quote unquote, of looking at the manual. 3 days later, you come back and you're like, yeah, take a look at the script. And I'm just, oh my God.
Yeah, I mean, I think that's partly because I come from having the knowledge in web design. So, I mean, I know a little bit of CSS, I know some basic HTML, but I mean, I know you don't build an algorithm out of CSS, but it's sort of, I'm not completely code illiterate, if that makes sense. So, I mean, I've got a little bit of an understanding on how you might kind of put something together. Even though when we start dealing with languages like ThinkScript, and I've more recently started getting into Python, which is pretty exciting, well, for me anyway. It's a very, very steep learning curve. But I think that's having that sort of web design background. I don't know that's a huge benefit, but it just sort of made me think that,
Well, it sounds like organizationally that would benefit anybody, just to have considered, well, what components am I going to need to build a web page? And I don't know if you can code an algo in CSS, but if you did, it'd be a beautiful and well-organized cascading algorithm. No, I'm just kidding. No, I'm certain that helped you. Having a predilection or predisposition is really the right word to code. You've seen it before. You've experienced it before. You've had errors before. Things haven't displayed properly, and you've had to debug them. So it's like you're talking about the logic of any code as well as a little bit of syntax. And I've noticed the same thing with CSS. There's a lot of parallels between that and JavaScript, which probably led you to your early development in ThinkScript and now moving, like you said, more towards Python.
Yeah, absolutely. So, I mean, something that I haven't really, obviously we speak quite often, but I haven't really spoken to you too much about this topic, and that is how I have been getting quite deep into Python, or trying to learn it, putting a lot of time into it. And I've sort of set a goal for myself to have, I know it's a little bit vague right now, but to have some sort of automated trading signal or setup that is automated in roughly about 6 months. So sort of by the end of the year, I'm hoping that I can be somewhere close to having an automated trading signal. And that signal would look something like this. It would be a swing trade setup. So it'd be based off technical analysis and certain chart patterns. It would probably hold trades for, a couple days to maybe a week or two. And it would run through interactive brokers. So that's kind of how I picture it.
And anybody who's thinking out there, man, 6 months to go fully automated, I think you have to consider how smart Aaron's being about the finite or discrete kind of, not to say simple, but the straightforward nature of what you might define as an automated system. It just has to be something that you trust the output of because you've tested it. It doesn't have to be a 20 component intermarket analysis signal. It can be buying a moving average crossover near the 200 moving average or whatever you want. It can be something very straightforward. So I think it's good on you to keep it limited and gives you an attainable goal, especially early on. You can always expand from there. Yeah.
So something I probably wanted to ask you was setting myself a goal of trying to achieve that in 6 months. I don't know if that's a little bit naive, considering I've never gone through this process of identifying a signal, testing it, and go through the different processes of taking that trade to a level where it's then automated, plugged into your broker. Is 6 months, is that a little bit ambitious, or how achievable do you think that is?
Well, okay, so we have to examine this at the time frame that you're trying to trade. So given it's a swing system, I think that's smart. It's kind of the Goldilocks approach. If you're trying to trade on the shortest of terms, an automated day trading system, you got to consider execution routes, market impact, slippage, commissions, all these things, because you're in a frequently trading system. And that's not even HFT. I'm just talking about an automated intraday system. On the other end of the spectrum, if you're a portfolio manager, you have all sorts of other considerations, fundamentals, intermarket moves, as I was kind of joking about before. I think you're doing it right by approaching it from the most accessible point. You're kind of trying to establish a beachhead of what if I did have a signal that I had vetted, I had evaluated, I had tracked for months, and I understood intimately. I'd feel comfortable deploying that, automatically. That's smart, and it's definitely doable within 6 months. I think if you'd go to portfolio management, that's a million other problems you haven't even considered yet. Intraday trading, another million problems in a different direction. So you're riding the knife's edge of potential here, Aaron, not to make it sound dire, but I think it's very doable. And also given your coding background, and you seem to have found a good few dozen expert traders to talk to. One or two of them may know a thing or two about code you could talk to. I'm pretty sure you're gonna bang this out. So,
yeah. Well, I certainly hope so. I mean, that's sort of why I've been leaning towards Python. Obviously, living outside of the States, I can't fund an account with Thinkorswim, and I believe Thinkorswim do have the capacity to deal with automation. Is that correct?
They do, but here I'll show my true colors. I promise, guys, I'm not a Thinkorswim shill. They are pretty expensive. And so if you're talking automated trading, the biggest worry for me is that you would have 20 trades a day and commissions would eat your lunch. So it's smart of you to probably work with something a little lower commission and a little more flexible that has a good API like Interactive Brokers. I've heard pretty much nothing but good things about them. I actually spoke to other traders in the past few days who've been working on the IB API, and they had good things to say about it too. So you notice what you're doing is you're trying to do this efficiently. You're not devoting your entire life, 20 hours a day and barely sleeping to learning Python. But similarly, you're not so far removed from it that you're not going to get anywhere. I think you're setting attainable goals for yourself. And look at how this parallels a trader's like profit and loss development. When you set unattainable goals, can you blame yourself for failing? Not really. You can blame yourself for setting shitty goals. So similarly, by saying, I'm not trying to develop the next HFT, and I'm not going to build a massive portfolio system, I'm going to backtest a signal. I'm going to evaluate and vet and then approve the signal. And then I'm going to start it, and we'll see where it goes. That could be trading once a week. It could be trading a couple times a week. It depends on how selective you are. But I think you're being reasonable about it. So if nothing else, maybe talking to 25 veterans of the market has aged you a bit and scared you. You're keeping it real, which is smart. So
yeah. So I mean, I'm pretty excited. I mean, learning Python and this sort of quantitative approach, I find it fascinating. It's really interesting to me. So
let's go back to the thing we were saying before about you have to know one way or another. There's that great Mike Bellafiore quote that you were telling me before. Do you remember it?
Yeah, so when I interviewed Mike, and I was thrilled to get the opportunity to speak with him, Mike Bellafiore, he mentioned a quote which really stuck with me. And that was, a lot of traders confuse psychology with a lack of edge. So I'll repeat that. A lot of traders confuse psychology with a lack of edge. And I mean, that just really stuck with me. And I mean, that sort of came back to that point, which I tried to explain earlier. I don't know how clear I was, but like, how do you know if you have an edge? Mm-hmm. Like, if you can't put any numbers to what you can expect from trading a particular setup, then how do you know if there's a genuine edge to be had in that? And I mean, I'm not saying that you can't make money as a discretionary trader at all. Definitely not saying that. I'm just saying this is like sort of the train of thought that I have right now.
It feels like it's more personally exacting. You have to be right. You have to be precise. And I think we were joking about this before. It's like the idea of a tongue twister, right? Humans are not good at being precise and doing these repetitive tasks always, and it's asking too much of us to be 100% right or to be 100% buying the low, selling the top. I think it's very smart to adopt the quantitative approach. You're right, but definitely we both know many successful discretionary traders. So who are we to judge, right?
Totally, absolutely. So yeah, all right. Well, let's keep this moving.
Sure. So it's funny because the next topic I had for you was just tied to the Mike Bellafiore quote. What are some other maybe quotes or episodes that have stuck with you? This is something I've always wanted to know your view on. What are some episodes that you think people should go and listen to that maybe they may not have caught the first time? Yeah,
so probably a couple of the interviews which I feel probably deserve a little bit more attention than maybe what they did receive, would maybe be Tim Walker's interview. So I spoke with him on episode 6. And funny enough, that was actually the very first interview I ever recorded. So from my side, it's a little bit sketchy, but Tim definitely delivers some great insights. And he is a gain trader. But even if you're not interested in that type of thing, I think it's still well worth a listen, because the majority of the interview is based on just sort of general trading foundations. It's a really good one to check out. So, and then probably the other one is more recent, and I'm not being biased because I know this is David Bush who mentored you as you were coming up.
Oh, sure.
So his interview I found really, really interesting, especially like a lot of his answers were almost kind of inspiring, from how he's come from sort of like a musician background. He's been a discretionary trader for many years, and then he's gradually taught himself to creating what he described as like a meta system, where he's got like up to 30 to 50 sort of different strategies all sort of tied into one. and how he now uses that to just sort of views trading in a totally different way. So he now like oversees trades instead of jumping on a trade and hoping that's going to result in a profit. He doesn't really care if there's a few losers, just as long as the overall result is positive.
That's that really smart, like, quantitative trader distance that and an algo trader will try and adopt. Of this doesn't reflect poorly on me if a trade doesn't work. I'm in charge of overseeing all these things. It's like being a manager. You feel bad if one of your employees has to get fired. Like, yeah, look, that's unpleasant, but it's not your fault, most likely, right? It just didn't work out with the employee. And very similarly, having that oversight or overseeing. I've always loved about Dave that he was really articulate. Like, you're right about the answers being almost inspiring. I think about, like, I could take a year to write a white paper that wouldn't sound as good as the stuff he says off the cuff half the time. But yeah, well, you've had so many great traders on. What can I say? I definitely liked Tim Walker as well, episode 6, and of course Dave, episode 23. So
yeah, so those would probably be like the 2 interviews which I think everyone should probably listen to. I mean, I'm probably saying Dave a little bit more so because he's definitely in that quantitative space, which is really grabbed me right now. So
sure,
I mean, that's another reason why I found that really fascinating. But yeah, definitely Dave's interview and Tim Walker's. And I mean, I don't want to try and like single out those two and say they were the best, but like, yeah, I mean, everyone is like given incredible answers. So I'm really grateful for everyone who's, given up their time and been open for an interview, because everyone's been really honest with their answers. So no one's really shied away from anything and try to, squirm their way out of it. It's been really good.
And credit to you for being humble. So I'll brag on your behalf, but the ebook as well that you recently put out, I'm obviously honored to be in that as well. But some great responses from the other traders. I loved getting to go through and see what other people would have said. It's just such a down-to-earth kind of like, what if you could go back 5 years in time and speak to yourself? What do you wish you could have told her? Not 5 years necessarily, maybe many, many more years if you're a more experienced trader, but just it's cool to hear, I say this, the insight you would have given to yourself. Or you would have given to others, or you could give to others right now.
Yeah, so. It's like that one lesson that you wish someone would have told you. I mean, that's what the book's called. So if anyone's listening and they haven't had a chance to check that out, just go to, I can't remember the direct link to it, but if you just go to chatwithtraders.com, you'll see ebook as a link in the top menu. So you can go there, check that out, and download that. It's free to download. And this brings us to a good point. So you had a piece in that book, Zach, and that was the one thing that you wish someone would have told you when you were sort of starting out. And that was, you mentioned you wish someone would have said that you need to disassociate yourself from the identity, the image, and the persona of being a trader. So what exactly does this mean to you? Like, and why is that important?
I just think that so many traders are in this game to tell other people that they're traders. I think so much of it is I want to say like badge of courage. Like, it's the thing we wear, the chip. There we go. The chip of courage that we wear on our shoulders. You know what I'm saying? We've got a chip on our shoulder. Like, it's the ego and mentality. I don't want to say machismo, because I've seen it in female traders too, but this kind of uber over competitiveness, feeling that they need to prove it to everyone around them. The truth is that nobody really cares, and nobody values it that highly anyway. Most people don't understand what you do. They don't care what you do. They think you're a gambler in any case. It's up to you to prove them wrong. Not prove them wrong like by talking a big game. It's not by prove them wrong by having enough monitors, although I'll be honest, I'm pretty guilty of that. I've got 5 sitting in front of me here. But, it's the trappings and kind of fluff, I think I called it, that we tell ourselves when we don't have an edge about, I'm going to be something one day. I'm so close. I hear that all the time from my trading students. I'm this close, Zach. I just got to get, the next. And everybody is that close to something in their life. Many times with. Yeah, go ahead.
Yeah, so let me just cut in there. And
yeah,
for those who do feel like they're so close but just not quite there, I mean, I felt like that for quite a while. I mean, I'm still not there, but now I've realized that I am quite a way away. But like, why do they feel like they're so close but just not quite there? Like something's just not clicking yet. Like what's the reason for that? Like, why do they feel that way?
Yeah. We were talking about it before with the kind of, I can observe a single chart that works. I will never know about the 99 others that don't. Traders are not pretty honest with themselves about tracking a system or strategy. Cherry picking is prevalent. Curve fitting is throughout this industry, and especially at the retail level, because you get guys who are not knowledgeable enough to backtest or to do an appropriate or robust backtest. They just find anecdotal evidence. And I think I'd said something on my podcast about intuitive, anecdotal, and mathematical. Like, you got to have all three. It can't just be, I've seen this happen before, and therefore it is a rule, and this is my strategy, and I will continue to find great charts like this. You may have found the far right edge of the distribution, let's say. You may have found the best trade, and you're holding that as the kind of most frequent occurrence in the data set. I don't think people have a lot of perspective on how far they might be. And so maybe this is something that I would credit you with. You are humble and self-aware in that by talking to many other expert traders, you realize, like, my God, these guys are still struggling through it and developing, and they're 20, 25 years into this business. If I'm 5 years into this business, how much more development must I have ahead of me? And so you've been humbled without having to pay the tuition. Does that make sense? You've not blown up an account, but you've learned from many others who have. I don't think a lot of traders are aware of the misfortunes of others around them. They're not realistic about how 80% of traders are gone every year. They just stop trading, and a new 80%. I'm definitely kind of incorrect in these statistics, but you see what I'm saying about there's a high turnover rate in this profession. I don't know.
No doubt. I mean, that kind of reminds me of something Adam Grimes mentioned when I interviewed him on, what was that? That was episode 21. And
I forgot. He was another great interview too.
Yeah, no doubt. He was like, you never arrive as a trader. Like, you don't reach a level and you're like, okay, I'm now a trader. I've made it. He's like, you just become a trader. You just always, I'm not explaining this very well with doing it justice.
No.
But
this ties into what we were saying earlier with the pendulum of development, that it's a never ceasing swinging of the pendulum. You don't just develop for a year and then go be a trader. You develop, you trade. You develop, you trade. You develop, you trade. And eventually you're 90 years old and you're a multi-billionaire and you stop trading. I mean, that's the plan, right?
That would be the ultimate.
6 months from now, an automated strategy. 20 years from now, the world. I think, I don't know. I mean, it ties in perfectly, I think, with what we're saying about it's a continual process. And the people who, maybe that's why people feel they're so close. And think about that. That's actually really funny that it ties in. When you think there's a destination in mind, you're always so close. Just one more day of travel, just one more hour, just one more mile. But what if it was about the journey? What if it really was just about driving? You never would focus on how close or how far you were. You're just driving.
Yeah.
Do you see where I'm kind of going with this? For the sake of the drive. I don't mean to get too cheesy and philosophical. I know we're all here for the money too, and this speaks to why traders often don't get where they're trying to go. The market, and this is a Denise Shull, I believe, quote, about the market as a mirror. It represents whatever you need it to represent. For many of us, it's the thing ever out of our reach. We're never going to master all of the market. We're never going to nail it down. But the challenge, the chase, the puzzle, the struggle, it's all part of some self-betterment process that often parallels what's going on in your life. And actually, we've talked about this on the pre-call too, life and work balance, finding time to be a trader, but also finding time to be a human being outside of trading. I've definitely spent many a month or a week, zoned in on this, and could have done better on the life balance side. So I'll admit to that.
Yeah, it's very easy to do that. It's I think we're all guilty of that to a certain extent.
It wasn't so damn exciting, and then we'd give up on it after a while and go do something normal. But it's you know what I'm saying about the ever further away, goal. It's kind of inspiring in a way. It's something to chase after.
Yeah, totally. Well, I mean, we've been chatting for about an hour or so now, so I mean, we should probably start to wrap this up. But is there anything I've maybe missed, or anything you'd like to add to the conversation, and maybe some topics we might have skipped over?
Well, you remember we came up with that really funny kind of 4-stage development of the trader. Guys, before we were on this call, Aaron and I were talking a little bit about how traders develop and the commonality of their development, and how some traders do things very differently. But I don't mean to put words in your mouth, Aaron. I'll take, like I said, credit or blame for this quote. But go ahead.
Yeah, so you were mentioning that, like, a lot of traders, they start out and they make money.
And they have no idea why.
Yeah, and then they lose money and they still don't know why.
Yeah.
And then they're still losing money, but they know why. They realize why.
They have some idea of what's going on.
And then eventually start making money and know the reasons for it. So it's kind of like those 4 stages kind of thing. So do you want to just sort of elaborate on that a little bit further?
Yeah. I mean, I just think it's funny, the parallelism of the construction of that phrasing. Like, you make money but don't know why. You lose money but don't know why. You lose money but kind of figure out why. And eventually maybe you make money and know why. Stage 2 is the elephant graveyard of traders. That is where so many careers have ended, in the losing money and not knowing why. I know that's not groundbreaking. I think many people find themselves at that point right now, probably. I hope you're inspired to recognize that, it's minimizing the money lost relative to the amount of experience gained. And so this is kind of like another traderism of, you'll always pay the tuition, but will you attend the class? Do you see what I'm saying? Everybody's going to lose some money. It might take you $5, $500, $5,000, $500,000 to learn the lessons of the market. And everybody's moving at a different speed. I mean, this is like what we were saying about the paralleling of life development too. Everybody is progressing through life at a different speed, and that's okay. It's the people who pay attention and try and learn these lessons early. So, after this interview, I'm going to go hop in a time capsule, go back 5 years in time, and read that entire ebook to myself. And then I'll call you from my yacht in the future, because I'll be a millionaire at that point. So.
If only.
Right. Well, I'm sure we'll expound more on that in the future. I think that's a great topic. The path of a trader. What is common? What is typical? What should people pay attention to? So often it's we learn these things after the fact, because that's when we build the experience. Man, I'll throw in another thank you. You are doing a great service to the community of traders by putting other great traders, and yourself now, finally, out there. As an example for others. I mean, it's just brilliant. And like I said, in I think a Twitter message or retweet, where were you 5 years ago? Where were you when I was learning how to trade? Why didn't I have this? It would have been phenomenal. So, Aaron, sincerely, man, on behalf of everybody, thank you so much, and thanks for coming on your own broadcast. And it was a pleasure to have you on your broadcast. And no, sincerely, man, it was good fun, and looking forward to continuing conversations and that auto strategy in 6 months' time.
Yeah, for sure. So I'll have to keep everyone updated on now that I've put it out there. I can't go back on it now, so better knuckle down. But yeah, thanks so much for doing this, Zach. It was really good to sort of get you to come in and kind of take my seat and swap sides for this episode. So we sort of changed it up a little bit. But yeah, I mean,
swap sides of the earth. When you said change seats, I was thinking, man, it's going to take me 25 hours to get there.
Well,
we are on diametrically opposite sides of this planet, guys. I'm in Cincinnati, Ohio, and Aaron is in Brisbane, Australia.
Yeah. Well, that's a really good point. But yeah, so if anyone wants to get in touch with you, Zach, how's the best way to do that?
Yeah, sure. You can shoot me an email at Trading Coach Z or Trading Coach Z for those of you in the States. That's TradingCoachZ at gmail.com. Or you can always hit me up on Twitter at Zach Hurwitz.
All right, good one. And if anyone wants to get in touch with me for any reason, more than happy to speak with anyone. I mean, that was partly my reason for starting this podcast, like I mentioned right at the start, that I'm keen to connect with other traders and just build a bit of a community and bounce ideas off each other and just kind of help each other out. So, I mean, my email address is aaron@chatwithtraders.com and my Twitter handle is @chatwithtraders. So you can catch me on either one of those. And I will. We'll have to do this again sometime, Zach, and drill down on things a little bit more.
I think 6 months and 1 day from now, we're going to have another interview. No, I'm kidding. Don't anyone mark that in your calendars. I'm just giving you a hard time, Aaron. Thank you so much for having me on, man. It's always a pleasure, and anytime.
No trouble. All right, guys, take care, and take care, Zach. We'll speak to you soon.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level. Doesn't your portfolio deserve the best? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Trade smarter with advanced charting tools, backtesting, a pre-built strategy selector, and more features. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involve risks and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey there, what's up? Welcome back to yet another episode of the Chat with Traders podcast. This is episode number 26, and thank you so much for tuning in. You know, at a young age, some people want nothing more than to be a trader. Well, this week's guest is one of those people. Brad Jelenic first started dabbling in stocks during his days in junior high. Then from college, he went straight into a Chicago prop firm. 13 years later, Brad is with the same firm and predominantly trades futures. So during our conversation, I of course asked Brad a bunch of questions around prop trading and futures-related topics, which he responded with so many great answers, and I think you're really going to enjoy them. But the part I found to be really interesting was listening to Brad talk about health and well-being and the emphasis he has on longevity in this business. So if you plan on sticking around and really want to make something of your trading career, I suggest you pay extra close attention to this segment. And I also want to bring it to your attention that Brad is on standby and keen to answer any questions you may have about trading. So if you'd like to ask him something, just go to chatwithtraders.com/26, and all you've got to do is just scroll to the bottom of the page and leave a comment. All right, guys, this is the Chat with Traders podcast. I'm your host, Aaron Fifield, and here is this week's guest, Brad Jelinek. All right, Brad, what's up, man? How's your day been going?
Pretty good, Aaron.
Awesome. Thanks so much for coming on the show, man. I'm really looking forward to hearing about your journey and just your views on trading. So let's get this underway by telling us about how you first discovered trading. Like, I believe you were in college at the time, and what was it about trading that really appealed to you?
Yeah, it was actually, I grew up in a small town in northern Wisconsin, and being from that area, there was really nothing about trading around me. So I discovered it before college even. I think junior high probably is when I remember reading Jack Schwager's The Market Wizards. And then I read the other, I think the Stock Market Wizards was another one. And from that day on, I was hooked on it. And I think the credit I would give to my gym teacher. We had to take a gym class. I think everybody did when they were younger. And he would check his stocks every day. And I would always be wondering, what's this guy doing? So I would kind of go over his shoulder, and he explained to me he would, buy this and it would go up and you could make money and you could do research on your own and have your own hours. And I was just fascinated with it. So that's kind of the beginning. And then when I went through high school, it was during the explosion of all the tech stocks, 1998, 1999, into year 2000. So I would spend a lot of my time in study hall in high school trading these tech stocks and just getting on message boards and finding hot ideas and basically momentum trading with no idea what I was doing. I've never even heard of a pullback or a retracement or a trend line. I was just following momentum basically. And I did really well. I think I turned like a $5,000 account into $100,000 or something like that. And then the one smart thing I did was I bought a car. Otherwise, I lost pretty much all that money. I had no risk management principles. I didn't really know what I was doing. So, but I was hooked. At that point, there was no going back. So that was part of my tuition and my early experience. And then I applied. I went to college, got a finance degree, just because I was basically interested in trading, and that was the closest thing I could figure out to do. And then when I finished college, I interviewed with a prop firm, and I was lucky enough to get a job in Chicago with a prop firm when I was I think I was 21 or 22. So that was kind of the start of my journey professionally, and I've been there ever since. So that's where we sit today.
Okay, that's really interesting. So you turned $5,000 into $100,000. That's really impressive. How did you do that? I mean, if you've been so new to trading and not really knowing what you were doing.
Well, it's not really something I would brag about, because it was more dumb luck of the times. It was in that year you could make money buying anything, and if you got in the right NASDAQ stocks that had a lot of hype to them, anything semiconductors, anything that was pushed on a message board that was new. I mean, it was crazy, and that was all I knew. So that's the environment. I wasn't professionally trading. That was more trading with my own account without any knowledge from people who know more about what's going on. So, the other side of it was I lost most of that money. So I made it and I lost it. And it was just kind of part of my experience. I wouldn't necessarily call that skill.
Okay. And what would you say sort of caused you to lose the majority of that money? I mean, obviously this was early on in your sort of career, but what sort of led to you losing it? Was it sort of the market changed and you weren't able to handle that? You weren't knowing how to trade in that type of market, or did you just sort of get overly confident, or what sort of happened there?
This is a great question. I mean, that's the learning lesson. All of the above. I think what happened was the market turned, and me being very young, 19, 20, 21 at the time, I didn't really understand what it was like to be in a bear market. I just knew the bull market. So when it turned, I was trying to buy these stocks on the way down, and it's like catching a falling knife. And the fundamentals were against me, the technicals were against me, and I don't think I had a good idea of how to deal with that situation. It had turned to a bear market, and I was caught unaware, underdeveloped, underskilled, and just not. And the market changed. And as I went forward in my career, that's always a tough time, when the market changes. But you develop a base of skills to deal with those things when you make it a profession or a career. And at that time, just didn't have that.
Okay, sure. So you mentioned just before that you went from college pretty much straight into a prop firm. Had that always been your intentions to go in the direction of trading at a prop firm, or were you is it just sort of something that happened? Like, I mean, a lot of traders just want to trade for themselves, you know what I mean? So what sort of led you into moving into a prop firm?
Yeah, I think I kind of had an intention to do it, but it also kind of happened that way. I was seeking it out because, having traded a little bit on my own, I knew that I needed access to capital, I needed access to resources, and I needed access to mentors and people who have come before me and could teach me a lot of things I didn't know. Because I had all the passion in the world and all the work ethic in the world, but you also it needs to be applied in the right way. And there was only so much I could do on my own. So getting into that environment really taught me how to harness a lot of those things from other people and see what people did well, what could I take from their strategies and apply to my own strategy. And eventually I crafted kind of a plan that fit me. But learning from other people was huge.
Okay, so do you think if it wasn't for your experience of trading within a prop firm that your learning curve might have been much more extended than what it was, perhaps?
Yes, I think so. I don't want to shortchange myself because I really worked hard to sponge up every last resource and to hunt down people who were successful and to learn everything I could to move me along my path. So I definitely worked very hard at that. However, without having access to that, it would have taken me a lot longer. I would have just had to go a different, probably slower route. It definitely fast-tracked me. Because when you're struggling, you can talk to people who maybe aren't struggling, and they explain to you what they're seeing in the market that may be working, and they can sometimes help you fix things that are wrong. And it's really a nice thing to have.
Yeah, for sure. That's really valuable. So when you initially arrived at the firm, what was the learning process that you went through? Like, what was the education that they put you through?
Sure. Yeah. At first, we would have classes and training. Just nothing earth-shattering in terms of secrets or things that. Just more of a structured environment is what I would call it, where you learn basic principles of risk management. You learned that you had to be accountable to a daily stop limit. You learned from other people who may have the ability to, ride their winners and press their winning trades, and maybe put out smaller feelers on trades that they didn't know and then trade it larger when it started to move their way. Different strategies, mean reverting traders, trend traders, spread traders, things that you might not have known about. You just had exposure. And I think over time, you just start getting in conversations with people and picking a lot of that up. And you kind of get out of it what you put into it in terms of how much you want to learn.
Yeah, okay. That's a really good point. So what would you say were some of the biggest challenges you faced sort of in your first year or so once you got to the firm, which affected your profitability?
Yeah, I think it took me 6 to 9 months to start making money and getting some sort of a strategy that I could have figured out. And what I went through early in my career was I didn't really take off. I would say, I did well my first 2 or 3 or 4 years. I made some good money, but I didn't really take off and kind of come into my own until years like 4 or 5, 6 in that zone. And it just takes time, it really does. And I think what I went through a lot was, and maybe this is my personality a little bit too, a lot of boom and bust cycles where I would do really well and then do really poorly. And I would have to, the emotional roller coaster was brutal for me. And as I've gotten older, it's been 12 or 13 years now, I've gotten a lot better at ironing those cycles out and staying more balanced, more in the middle, and just having an awareness of, that how it used to be for me and how it doesn't have to be that way.
Okay, so where were your sort of emotions coming into the picture as you were losing money? Obviously, when you're making money, you're pretty stoked, but how were your sort of, how did you overcome the issue of dealing with the emotions of a losing trade that was leading to the bust?
Yeah, it took time. A lot of personal growth went into that for me, because I think it was part of my personality to be impulsive, which could be a very good thing in terms of reacting properly, not being trigger shy, being willing to take risk. I think those are very important traits of being a successful trader, but they also can hurt you when you're over impulsive, you're over trading a slow range, you're making a big deal out of something that's really not your setup. And that was something that I probably struggled with in my regular life, in my personality, and I brought that into my trading, which is a pattern that I think a lot of people have. So the emotion would come from just having something work for a few months. The market was in a situation that I understood, and then when that situation would turn, it would take me a lot longer than it probably should have to cut my size back and to figure out that things have changed. And then that's when the busts would happen, where I would have, the busts wouldn't ever be as bad as the booms were good, if that makes sense. But they were bad enough where it was part of what crafted me into who I am today, I think. And that was it was painful. And I learned from the pain eventually, but I think it could have probably been shorter than it was sometimes.
Okay, sure. And I want to pick up on that a little bit more as we get into this. But I presume the firm sort of offered you the one-on-one mentoring and coaching, like you've kind of already mentioned. But did you ever receive any help from perhaps someone like other traders who are outside of the firm?
Yeah, I would say that some of the traders inside the firm were my became really good friends and mentors. Outside of the firm, that kind of took time. I've built up a better network now of people, personal friends from outside the firm who I can talk with now about their trading and their views. And that kind of, eventually you meet people through different people and you build that network up over a few years. But I would say the core of my development came from people within the firm, because that was who I was immersed with every day. And that was satisfactory to me at the time.
Okay, sure. So you would say that sort of the guys who you met outside of the firm were sort of friends of friends? Because I'm always curious to know how like other traders meet other traders, because a lot of traders find this a very you could say a lonely kind of journey. So I'm always interested to hear how other traders are connecting and meeting with other guys and sort of doing similar things.
I found the same thing. It is a really lonely journey, and it's very difficult. And I think being in a firm made it a lot easier, because I was able to, use other people's networks. You make friends with somebody in your firm. They have friends who trade at either different firms or on their own. And then you have access, you go out and for drinks, for dinner, to social events, and you meet these people. And that definitely played a role. So that was really big. If I didn't have that, what would I do? I think I would probably try to get involved on some form of social media, follow people who maybe made comments that jived with the way I wanted to trade, comment on niche blogs of people who I enjoyed their content, and maybe strike up a relationship of like-minded individuals. It's hard, though. It's hard work. It's not easy, and I understand the difficulty in that.
Yeah, for sure. Those are some good points, though. So, yeah, we'll definitely take those on board. How would you describe your trading approach? Let's get into that a little bit. So I believe you're predominantly a day trader, but do you want to talk to us in a little more depth about the way you're trading?
Yeah, no problem. Mostly a day trader. Futures markets predominantly. Some stocks I do, and some longer-term swing trading with kind of outside of my firm's business. But for the most part, it's day trading. I would say S&P 500 futures are the majority of what I do. I'm just a point and click trader. I don't have any sophisticated computer systems or anything like that. I trade the euro currency, fixed income products like the 10-year and the 30-year note. I trade those once in a while. And I do a lot of event trading. So, if there's a situation going on in the world, an election, British pound election, or the UK election, I traded the pound. Unemployment numbers, ECB meetings, Federal Reserve meetings, I'll trade the products that correlate with that stuff. But for my core of what I do, it's looking at equity futures, Europe and the US, mostly the US, and yeah, you can ask me about another question if you want on that, but that's basically what I do.
Okay, sure. And before we go any further, could you just tell us what is it that attracts you to trading futures over other products such as like individual stocks and that type of thing?
Yeah, that I thought about that because I thought you might ask something like that, and I think a lot of it is that's the situation I fell into. One of the things I've learned is you just kind of, when you go with a firm, you make the best of what is offered to you and you leverage those resources. So if you have people who do a certain thing well and you have resources in that department, it makes sense to learn from that. And you hear a lot about trading to fit your personality and trying a lot of different things to find the proper time frame. And I think that's really good advice, and I agree with that. However, when you're in a firm and they do something pretty widespread, it pays to learn, and that's kind of part of what I did. I used what was around me, and that was day trading, and that was futures. And there's a lot more leverage also. So for making a lot of money on a little bit of capital, it made sense in terms of especially for a new trader and a beginning trader.
Yeah, okay. That totally makes sense. So in your view, what are the forces that drive futures, let's say a stock index, and how does this differ from the forces that drive perhaps individual stocks?
Yeah, I think the setups and the logic is very similar. By market logic, understanding, taking out technical levels, market positioning, people stuck short or stuck long, markets not reacting to news properly. I think those concepts are valuable in any market. Stocks, you have your earnings reports and your fundamentals, your sector rotations, and then of course the overall market. With futures, indexes, and things like that, currencies, there's more macro related stuff going on. So economic data matters more than it might to a stock, or the unemployment numbers, the inflation numbers, and that stuff keeps coming in and out of flavor depending on where we are in the market cycle. And give you an example of like something the other day, I think it was a week or two ago, there was a U.S. retail sales number, and I was looking to trade the 10-year note. And so if the number comes out strong or high, that would be positive for stocks and negative for the 10-year note in theory. So what we had situation going into the number was the 10-year note had sold off 2 or 3 days going into the number, anticipating a retail sales number that was going to be a little stronger. So when the number came out, it was a little stronger, but not that much stronger, maybe slightly stronger, I would call it. And what you got was a little bit of a sale in the 10-year right away, and then it rallied all the way up the rest of the day. And that's an example of, in my mind, it'd be market positioning. People expected it to be a certain way. It did come out that way, but once it came out, there was no one left to sell, and then the market reverses and moves higher all day. And I think when you see something like that, you can trade that theme the entire day. So that would be one example of an event trade or a news trade that I would look for.
Okay, and this might be a bit of a newbie question, but you mentioned the number coming out and it's going to be higher or lower. Mm-hmm. How do you know if it's higher or lower? Like, where's the benchmark kind of set?
Right. No, that's fine. That's a good question. That's usually if you just look at, you can Google search any number, and you can get a consensus. Usually there's so many publications that will post economic data calendars with, the number is expected at 1% and the highest estimate is 2% and the lowest estimate is 0%. So you just kind of get an idea. It's pretty public information, an idea of what people are looking at. And then you kind of can form, you can make trades around that if you study the market and you feel like it misses a certain way. That's just one thing I would look at.
Okay. All right. Cool. So how much of your trading is weighted on technical analysis versus the fundamentals and news, which you've sort of just mentioned, but how much of a factor does technical analysis have in your decision making?
I think technical analysis and fundamental analysis are both really important. I think on my bigger trades that I really like, I will have both of those things working for me. I think when I try to do a lot of reading on the fundamentals, since I'm day trading, a lot of times, technicals and market positioning, which I mean as people stuck long or stuck short, something to that order, have more of a impact than the fundamentals. But when you get a fundamental day or a fundamental theme, it makes it way more powerful to go with the technicals, and that's when I'll trade larger. So that's something I always try to keep my reading up to date and know what may be a surprise or what may affect certain, equity futures, indexes, currencies, bonds, whatever I'm watching. So I know if something shifts fundamentally, now I need to look for technical divergences, technical patterns that I like, and I can get even more aggressive because I have more things in my favor.
All right, great. So just while we're on the topic of technical analysis, what are some of the indicators that you use, or perhaps things that you look for, such as, support and resistance and that type of thing? Like what do you use out of the whole range of different technical analysis indicators?
Yeah, I use price action a lot, and I used to, I'll start off by saying, I guess I used to be able to read the price book a lot better in the futures markets years ago. You could see the order flow. I could tell when there's buying or selling. And with computers, machines, algos, whatever you want to call them, being such a big part of the market now, it's made it a lot harder to read the order book. So that is less. That was one of the big changes I had to deal with and I had to adapt to, was adding another element to my trading, because that kind of got taken away. It became a lot more difficult. It just became noisy. So the market would still move from A to B, but it would do it in a manner that was a lot different than it used to be. And I think that was something that, because of that, I added some more technical indicators. And some of them that I use are just really basic stuff like MACD divergences, stochastic divergences with price. Price makes a low. The stochastic doesn't make a low. Things like that. Now, I'm not trading on that stuff, but I'm using that stuff to get in if I already have an idea. So if I have bullish fundamentals and I feel like I want to find a place to buy, maybe that would be one of the things that would get me in, as opposed to reading the order book, which I used to do, but has become a little more difficult. So I listed those stochastic MACD divergences. I also look at unfilled gaps. So if the market opens higher or lower, I like to use those as targets to later on, when the market moves towards those areas, it likes to fill those areas in. So I will have a marking on my chart where those gaps are. I like to trade into those. I'll draw basic trend lines if they're obvious on the chart. I'm aware of technical analysis patterns just because I want to know, basically, if people are using them and they're wrong, I want to know that they're stuck. If a head and shoulders pattern fails, I want to know that so I can go the other way. It's just that kind of logic is probably as important to me as the textbook logic of technical analysis. Okay.
I really like that point you made there about how, if it fails and you can see that people are stuck in that trade and you're going to go the other way. I think that's a really good point you mentioned. So the other day when we were speaking, I thought it was really interesting because we haven't really discussed on the show too much, and that's hedging positions. So do you want to tell us a little bit about how you hedge positions to reduce your risk?
Mm-hmm. Yeah. One thing I do, and I don't do this all the time, but if I have, so this year I've been doing it a little bit more with European index futures and U.S. index futures. When I want to buy, I'm bullish equity markets. They usually move together, but sometimes you'll see Europe is weaker or the U.S. is weaker. So a lot of times if I see that, I think the overall market's going to move up, but I feel like Europe is going to move up faster than the U.S. What I'll try to do a lot of times is I'll buy Europe in an area on the chart that I like, and maybe it goes my way a little bit, we'll say in this example, but I'm looking for a little bit bigger move. A lot of times I will sell the U.S. against it, put on a spread. And I'm not so concerned about the exact proper ratio of the spread. I just want a little protection because I'm trying to sit through the market noise. And if my analysis is correct, a lot of times what happens is I'm able to sit in my bullish Europe position and sit through some noise, or even have it go against me a little bit because I'm protected in hopefully the weaker product. And a lot of times I will take that hedge off and just use my outright long position in Europe to ride the market higher. And then I might get back into the short U.S. position later and get out of the Europe position and then try to stay short in the US, and that would be the perfect scenario that I caught both sides, which doesn't always work that way. A lot of times I also get hurt on both sides, but I think it pays to look at that when you feel like you understand a fundamental relationship about why one product should be stronger. And it can help you sit through a lot and sometimes make money in some choppy markets that you otherwise would be hurt if you were just trading one product.
Okay, and again, this might be a bit of a newbie question, but when you're hedging, is there a chance that you can end up losing twice as much?
Yeah, there is a chance, because if my analysis is wrong and the US is stronger, not weaker, and Europe is weaker and not stronger, they could both go against me. So that's happened to me before. It's definitely a risk. It's something that it's just one strategy I've used, and I use it mostly when I feel like I have a good understanding of why one market should be stronger. But it's not something I think. To answer your question, yes, you could lose on both sides. We'll leave it at that.
Okay. And at what point is it maybe worthwhile for a trader to hedge a position? Like for someone who might be trading a $5,000, $10,000 account, is this an effective strategy, or is hedging more relevant when you're handling larger amounts of capital?
I think when you're trading a smaller account, my strategy would be to keep it extremely simple and find one or two things that you can do well and stick to those things. And as those things become comfortable, you add another thing. So the hedging can sound very confusing, but it doesn't have to be. I mean, it could be something like you want to buy energy versus the rest of the stock market. So you're long energy and you're shorting the overall market because you feel like energy is going to outperform. So you're kind of protected a little bit against the market, but it could be a simple strategy like that. But I think if I was newer, when I'm starting off, I didn't get into this stuff probably until 4 or 5 years in, that it would just help to be very simple and find maybe one or two patterns that you like. And maybe when they don't work properly, maybe that sets up a trade for you. Maybe when we don't react to news properly, that sets up a trade for you. Just something very simple.
Okay, sure.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
So here's a question I'd like to ask you, and it's based around risk. Would you say the way you view risk today has changed from the way you viewed risk in the first year or couple years of your career?
It's funny you asked that, because I have been thinking about that a little bit lately. The answer is yes. I thought that would never happen. You hear about there's a saying, there's old traders and bold traders, but there's no old, bold traders. And, I'm starting to feel that a little bit, I think, and I'm not even that old, but just if when you're younger, you just have this reckless abandonment for taking risk. And I think it's natural when you accumulate a little larger account and you've had a little success, you start to not want to lose what you have, and to be a little more protective. And also it mixes in with just your general makeup as a human being. And, as men get older, their testosterone goes down. I mean, I guess for women, it'd be a different question, but all of it kind of plays into the fact that your risk-taking gene or whatever ability tends to go down when you get older. It really does, because you know what can happen. You've seen the nightmare scenarios. You've seen the blow-ups. You've seen people around you get hurt. And it makes you a little more risk-averse, which doesn't have to be a bad thing. It can end up meaning that you're more consistent and you take less big winners and losers, but you're more steady. So I think that doesn't have to be a bad thing.
All right, cool. So, Brad, if you could, share with us, how do you go about reviewing your trades and sort of reviewing your performance, and how often you might sort of take a look at this type of thing?
Yeah, I do a lot of work on this. What I'm currently doing is for 4 years when I first started, I used to plot my trades every day. So I would print out the chart. I would take red and blue pens, and I would do a dot where I'd buy and a dot with a circle where I'd sell. And when I would short, I would do the opposite. I'd do a red dot and then a blue dot with a circle where I would buy back my shorts. And I would go through every day and look at those charts and see, was I getting poor spots? Can I get better spots? And I think it did help. It created an awareness to not be trading in bad areas that carried over into the next day. I eventually stopped doing that because it took so much time, and I thought I was kind of at a spot of diminishing returns. So what I do now is I use Microsoft OneNote. It's kind of like Evernote, if you've heard of that. And it's basically just like an online notebook. And I cut out my chart every day with just like a cut and paste program, and I paste it in there, and I write down. A good friend of mine who's a great trader gave me this advice, and it was some of the best advice I ever got. He said, instead of looking at all of your trades and looking at what you did wrong, only write down what you did right or what you wanted to do right but you didn't do. So now when I review my trades, I just go back and I review the setups that ideally, if I was thinking right, I would have done, or the ones that I actually did. So at the end of the day, I'm just looking at and teaching my brain, this is what I want to do. And the next day, I'm more apt to do what I want to do versus beating myself up because I may have made a bunch of dumb trades the previous day. Because what you're telling your brain when you do that is dumb trades, beating yourself up. And then the next day, you're just attracted to do things that you don't want to do. Even though you think you're helping yourself, I found out that that's just not very effective, at least for me. So this has made I think it's made a big, impact on my results by changing my thinking and kind of tricking my brain into looking for what I want to do.
Okay, I think that's a really interesting way of looking at it. So, yeah, thanks for breaking that down, Brad.
Yeah, and I could like to add one more thing. On the trade review, another thing I like to do is I like to tag. So I'll tag news trades, I'll tag event trades, I'll tag retracement trades, breakout trades with a little, it's a software feature. So then later on I can go search, and I start to build like 10 or 12 trades that I've tagged, and I can search them and see what's working, what's not working. And then I kind of have a little book of trades that way, and then I can kind of go back and see how I'm doing on certain trades. And then when I struggle, I can go back to what was successful because I've documented that.
Okay, that's really cool. When we were speaking a little bit earlier, you were talking about sort of how the market goes through cycles and, things just change over time. Like you mentioned that computers have become more advanced and you're almost competing against them to a certain degree. Could you give us an example of how you've had to change the way you trade to adapt to sort of new market environments?
Yeah, I think for a trader, that's the challenge that never goes away. We always have to keep adapting to who knows what's going to come next. And market cycles are always there. But I think for a day trader who's been, I used to trade a lot more than I do right now. I think I'm a little more, I sit on my hands a lot more now, because what happened is slowly more and more of the volume was becoming computerized. And I think I touched on this earlier about it still moves from point A to point B, but it does so in a different fashion that's confusing for humans to watch and anticipate. So a lot of times I'll have to pick my areas. I'll have my fundamentals and my, some of those technical divergences that I talked about, and I'll find my areas that I like, and I'll get in maybe a medium amount of size versus what I'm trading. I'll put in a little wider stop, and I'll let that thing work, and I won't micromanage it as much as I used to, because I get shaken out when I try to micromanage it. So that's been, for a long time, I kept doing what used to work, and I was seeing results that were not what I wanted to be. Not as, if I had a great idea, I would look at it at the end of the day and see, I did my idea, I made a little money on it, but I really didn't capitalize on it properly because I was trying to scalp or trade the whole idea, but the order book and the computerized trading made it a little tougher. So sitting in the trade, ignoring the noise, seemed to be a better option for me. And that's something I've done, I would say, the last year especially, and it's helped me a lot. It's made a big difference.
All right, sure. And this is something I heard you mention during an interview you did with Futures Radio. And you were talking about stories and themes within the market. You might have already touched on this a little bit, but would you be able to elaborate on this point and tell us what you mean by sort of stories and themes? And maybe again, if you could share an example if one comes to mind.
Yeah, for sure. I mean, that's a big part of my trading are themes and stories. And when I hear a story, what I mean is something I can understand fundamentally, and it might not be something that's really obvious to everybody. It's just something that I've kind of developed because that's the way I look at the market. And one thing I mentioned was the 10-year trade with the retail sales number. Another thing could be something to the order of, we have a move in the market, and let me think here if I can give you a good example of something that happened. Okay, I have one. I traded an unemployment report in the market maybe 3 or 4 months ago, and we had a really good U.S. unemployment report. And that should have been bullish for the stock market. Non-farm payrolls missed by 80,000 or something like that. And their instant reaction was exactly what you thought. The market moved up. And then what started to happen after that was it started to slowly kind of bleed down, and it felt heavy, and it probably shouldn't have been that way. And the fixed income market, the 10-year note market, it also started acting in a similar way where it wasn't doing what it should have been doing on the news, especially given that the number was pretty surprising in terms of missing analyst expectations. And about halfway through the session, I think it was actually not quite halfway through the session, we got an announcement that I think it was an Apple computer was added to the Dow, and that caused the market to spike up a little bit because that was more people who are in that index have to buy Apple. And right away, the market just popped up and came right back down. And that was two things now that maybe should have been a little positive. The Apple news mattering a lot less than the unemployment news, obviously. And what happened was we started to continue down. And at that point, my theme and my story is kind of in for the day. It's that we got this surprise news. We tried to rally, and we can't rally. And then some other secondary news came out that might have been bullish. It's not being bullish. And at that point, that's where I'm using my technical divergences and other things to just sell rallies all day long. And the market kind of continued to trend down. And so those technical divergences on a day like that, where I feel like I have a story being we're not reacting to news, is more powerful to sell a technical divergence on that day because I have something behind the divergence. Whereas on a regular day, if I'm selling technical divergences, well, if it was that easy, all of us would program a computer to sell technical divergences all day. It just doesn't work that way. So you need something else. So when I say story, I'm talking about something else, and a reaction to something maybe that doesn't add up, or even a reaction to something that does add up. Maybe we get a number that misses, and it's kind of that break the bank number that we've been waiting for, and we rally all day long. Well, that could be a story too.
Yeah, okay. All right, that's really good. Thanks, Brad. Let's move this along a little bit, and I'd like to bring up the subject of health and well-being because I know you're a massive advocate for this. So this course, is important to everyone, but I feel like many traders probably don't give this the attention it deserves. So let me ask you, why is your health and well-being especially important as a trader?
Yeah, I mean, when I first started in my early 20s, I would, I'd be at my desk all day trading for 10 hours, multiple cups of coffee, sitting in my, hunched over at my screen, turning my head at weird angles, having neck aches. And, we can laugh about it, but it's not a good way to do this for a long time. And I think that going through some of those boom and busts and coming home and feeling like I wanted to cancel my evening plans because I had a bad day, or being very happy because I had a good day, is just not a good way to live. And it sows the seeds for misery. And I've figured out that, balance, exercise, moving around, going for a walk during the day, talking to people about other things except for trading, taking vacations. I got into meditation morning and night, have made a huge difference for me. They've kept me a lot more balanced, and I think it's going to give me that longevity that I need.
Okay, great. And this, I presume, includes having a healthy balance between sort of trading and your personal life. So how do you consciously manage this?
Well, I mean, I used to, when you get together with a group of traders, all they want to do is talk about trading. And I'm the same way. I'm always willing to talk about trading. Ask my wife. It's always, when there's another trader around, that's what we talk about. But I think it's important, and it becomes refreshing when you're a little older and you've been doing it longer, to talk about other things, to get exposed to other things, and to just totally get away from it. Take your vacations and just realize that the more, it's like a pendulum. Everything's like a pendulum. If you swing too far to one side, you have to swing back to the other side. That's just how things work. And if you get too into your trading, what happens is you get too connected to the results, and you can't help but be overexcited and over upset depending on good days and bad days. And that the meditation practice I use is very similar. It's just about observing, but not reacting necessarily to the emotions and the things that come in your experience during the day. And that's helped me maintain this attitude and just keep that perspective as long as I can.
Okay, let me ask this. What are some of the things you do either on a daily basis or regularly to sort of keep yourself both healthy mentally and physically?
Sure. So a typical day would be, I would get up in the morning, I have breakfast, small cup of coffee, I prepare for the market day, and then I go downstairs, I meditate for 30 to 40 minutes. I go up, I trade for 2 or 3 hours. Unless it's extraordinarily busy, I'll stay all day, but I usually leave then in the middle of the day, go for maybe a 45-minute walk, or I'll listen to an audiobook or something, or I'll just walk with no noise. And then I'll grab lunch, come back, I'll watch the afternoon session. Maybe I'll trade a little bit if it's busy. At the end of the day, I'll review my trades for about a half an hour, 40 minutes. I will then usually go to the gym or go to a yoga class, come home, have dinner, try to do a little reading or something not related to trading, maybe watch a TV show, and then meditate again at night and go to bed.
Okay. And I'm not sure quite how to ask this, but a lot of these things, so, you're taking breaks during the day, you're not sort of immersing yourself in trading at night and sort of first thing when you get out of bed in the morning. Is this a lot easier I presume it's a lot easier to do this and be as comfortable to do that once you've reached a level of success and you're much more confident in your trading. Would you agree with that? Like, it's while you're younger and you're trying to, you're really eager to learn how to trade, and you feel like the more effort, the more time, the more hustle you put into it right now, the better the results are going to be. What are your thoughts on that?
Super good, really good question, actually. I mean, when I was younger, it was almost the opposite. I was in front of my screen constantly, watching, recordings of my screen, always hustling and doing stuff like you said. And I think that did help me a lot. But what I've realized is you get wiser as you go along. I realize there's a time for that and there's a time that's not for that. And when it's very busy or in a recession or something's crazy going on and you get the volatility, that's the time for that. When it's not as busy, trading parts of the day, taking breaks, seems like you're not working hard or you should be doing more, but in fact, you're helping yourself because you are saving your energy for a time when you need it more. You are balancing yourself properly, and that's what I've found. I'm not saying that's truth for everyone, but it's really helped me pick my spots because, if you want to do this for 20 or 30 years, you need to pick your spots a little bit. And if it gets very busy, you'll see me move my hours. I'll be earlier. I won't take those breaks as much because the opportunity is so good. But I think the balance takes priority to the market hours for me because I have my strategies and my things I want to do. But a lot of times in the middle of the day, you just don't get a lot of action. So if I'm sitting there, I'm forcing things and I'm feeling like, the temptation to do that is greater. And when I leave and come back, I get that fresh perspective and that mindset that's the mindset I want when I'm trading.
Okay, sure. That's really well said, Brad. So all in all, besides feeling better and sort of being healthier, you would agree that this has had an impact on your bottom line, just sort of tying it back to trading. You've had better results as a trader directly related to sort of your meditation and your just general taking care of yourself.
Yeah, definitely. And I think the big payoff is going to be because as a trader, a lot of the money comes when the market starts to loosen up and you get the volatility. So, the best money will come when you're doing these things, but they line up with that good market. So that's the market is a big part of it because in a good market, average traders do well, new traders make money and good traders do extraordinarily well. And in a bad market, you can take everything down a notch. So I think that's important to recognize that a market can make trading easier if it's conducive. But what it does, the best way to answer your question is longevity. The longer you're in the business making money, the more money you make. So if it prevents me from burning out, well, I can't put a price on that.
Yeah, no doubt. Really well said. All right, Brad, well, this has been awesome, and I'm sure we could continue for much longer, but I know you've got places to be, so let's sort of start to wind this down, and I've just got a few more questions to throw your way. So,
sure.
I'd like to ask you, what would you say is the number one reason you believe the majority of traders never reach a high level of success? If you had to put it down to, say, one or two things, what would it be?
I think you have to have one thing I would say is that desire and that fight inside of you that you really want to do this keeps you going. Because everyone's going to go through really tough times when they're trading, really dark days when they're trading. But it's that knowingness and that willingness to do anything it takes. You can't defeat someone who keeps getting up, after every setback. So I think that would be one thing. The second thing would be, for me, it was to learn that when I understood something, I needed to trade it larger. And when I was not trading well, I needed to cut my size down drastically sometimes and get out very quickly and learn that if I do that, I'll stay alive. And if I stay alive, I'll be able to figure out something that I can trade bigger again in the future and start to normalize myself. So it was managing myself that way in addition to the desire, I think, are the two things.
All right, both really good points. Is there one book which has really helped you grow as a trader that you would maybe recommend to others?
The whole Market Wizards series. I like the new one the best. Hedge Fund Market Wizards is Jack Schwager's newest book, and that pertains more to recent times. So I listen to those on audio 2 or 3 times. I like audiobooks because I'm walking a lot, so I don't have to sit and read. I can do it while I walk. Those have been fantastic because you hear stories from people who have gone through this stuff. You've heard how hard it's been and how they bounce back, and you've heard, that some of them didn't make money for a few years, some of them blew out, and it makes you feel, it humanizes things to you a little bit more because sometimes you think great traders just always have success, but nobody always has success.
Yeah, absolutely. And if anyone's interested, I'm actually having Jack Schwager on the podcast in a couple of weeks' time. So I'm pretty pumped up about getting to speak to him. It should be a really good one. Is there any final piece of advice you'd like to leave with anyone listening?
I I think seeking out a mentor, seeking out like-minded people who can help you on your journey is always something that you hear that over and over again, but I had that when I started, and it's really helpful. And I think if you're on your own and you feel like you're on an island, making a point to either get into a firm or get with someone who can help guide you along your path.
All right. Awesome advice, Brad. Thanks again so much for coming on. Before you run away, is there any way that listeners can either find out more about you or connect with you?
Yeah, I would give you my email address. It's probably the easiest way right now.
Okay.
It's JELINBRA1@gmail.com.
All right, cool. We'll put that in the show notes. And I should have probably asked you this beforehand, Brad, but if you're open to it, would you be willing to answer questions that anyone might have if they just leave a comment under the interview at chatwithtraders.com?
Yeah, and anybody who wants to email me or ask me questions, I'm more than happy to talk.
Okay, good stuff. So if you've got a comment or a question for Brad that you'd like him to answer, just go to chatwithtraders.com/26 and just scroll to the bottom of the page and drop in a comment there, and Brad will get back to you about it. All right, Brad, this has been awesome. Thanks so much, man. Have a good night, and let's talk soon.
Yeah, thanks for having me on. It was great. Talk to you later.
No trouble.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level. Doesn't your portfolio deserve the best? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Trade smarter with advanced charting tools, backtesting, a pre-built strategy selector, and more features. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory, exchange, and clearing fees still apply. Options involve risks and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey, what's up, everybody? Welcome back to a brand new episode of the Chat with Traders podcast. This is episode number 27, and I have a very special guest lined up for this episode. The chances are you're already very familiar with who he is, and if you're not, then I'll probably have to presume you're new to the realm of trading. Jack Schwager is the author of a number of widely acclaimed financial books, including the timeless Market Wizards series, commonly referred to as all-time favourites by many of the guests which have appeared on this show in the past. As well as a best-selling author, Jack is widely recognised as an industry expert on markets, hedge funds, and trading advice. He's also the co-founder of Fundseeder, a platform designed to find undiscovered trading talent and connect successful traders with capital from investors. During our interview, we discussed Jack's lifetime involvement with markets, some of the key lessons he's learned firsthand from interviewing many of the world's greatest traders, and so much more. I hope you enjoy this interview as much as I enjoyed hosting it, because it was an absolute honour to speak with Jack for almost 90 minutes. All right, guys, here it is. I'm Aaron Fifield, the host of Chat with Traders, and here is this week's guest, Jack Schwager. Hey, Jack, welcome to the podcast. How's it going?
Oh, great. Thanks.
Awesome. Well, I must point out, first of all, that I'm not doing quite so great because I woke up this morning with a damn cold. So I'm dealing with a bit of a croaky voice here, which is annoying, but the show goes on. So, Jack, an absolute honour to be speaking with you today. Thanks so much for making the time to come on the show.
Thanks.
So, a few of the topics I'm keen to speak with you about today would, of course, be how you originally got involved with the markets, and also what inspired you to become an author, and some of the key lessons you've picked up from interviewing so many super successful traders. And I'm also keen to find out more about what you're working on these days with Fundseeder and other various projects. So how does that sound?
That sounds good.
All right, great. So, many people recognize you as an author, and aside from your books, may not fully understand your deep involvement with markets. So, winding back time, what was your very first introduction to markets?
Well, other than as a kid, I guess having my little bit involvement in stocks, very minor, not a great interest. My father, bought some stocks sometime, but really trivial. There was no real interest. I wasn't one of these people like the market wizards I interviewed many times, really had a passion for markets starting in high school. That was not me. My real introduction to markets really came because I was out of graduate school looking for a job. I had a master's in economics and a minor in math, and I from a good university, and I figured I should have an easy time finding a job. Actually, it wasn't hard, but I kind of expected to have a job the first day I looked. It ended up taking 2 weeks, but I actually found my own job because I got discouraged with dealing with employment agencies. So I put an ad. At the time, there was the New York Times had actually was sort of instead of the opposite of a help wanted. They had help wanted, but they had a small section where you could post an ad if you were looking for a job. And I did that, and I just put in the 2-line, the cheapest ad I could put in, and it cost me about $15. And basically said something like, major in MA in econ, minor in math, looking for an analytical job. That was pretty much it. And I had about 16, 17 calls. Of those, all but one were really the types of calls where they try to make you think that there's a position, but what they're really trying to do is get you involved in a pyramid selling scheme or some other exploitative thing. And I guess they use those type of ads to find people who they hope will be patsies. But there was one legitimate response, and I called back on that one, and it ended up being the job that I ended up getting, which was for an analyst position in the futures research department. And that was and I knew nothing about futures at the time. I knew almost nothing about markets. Economics degrees, particularly, even today, I guess, maybe today's maybe a bit different, but still probably don't prepare you very much for anything to do with markets. But back in my day, they did, markets were not even on the curriculum. So I really knew nothing. And that's how, but I got into the job because the research director, a fellow by the name of Xauusd, was the writer of a commodity column for Barron's. And he was looking to replace his analyst who was leaving. How it was, by the way, Michael Marcus, who was chapter 1 of the first Wizards book. That's how I met Michael. Anyway, he was looking for a replacement, and since he had this column, he thought it was a good idea to kill 2 birds with 1 stone. And all the serious candidates that he got, or I guess he narrowed it down to 4 serious candidates, he had each of us write a column, and I got, to a market that he had to write a column on anyway, and I got assigned copper. So not knowing anything, I basically went to, I lived in Brooklyn at the time, and there's this huge library in Brooklyn called, Grand Army Plaza. And this is way pre, it's pre-PCs, let alone pre-Google. So you didn't have that type of luxury. So I had to go and I had to go to a really big library to find stuff. And they had these periodicals. There was one, there was an American metals market, I think, there was a daily newspaper on metals. And then there was a McGraw-Hill had a weekly or a bi-weekly on metals. And then I found some additional articles. And so I basically did a crash course education. I went back several years worth of reading articles and writing and just reading the background articles I could, and wrote an analytical article on the copper market, which basically is what got me the job. So you could say writing really got me my first job. Well, you more than could say. I would make it a definitive statement. Writing did get me my first job.
Okay, right. Well, that's a really interesting sort of intro into the market. So even after you began writing books, a bit later on, you were still involved with other firms. So could you run us through some of the other firms you've worked with over the years and what was perhaps...
Well, I worked for a number of major brokerage firms. Some of the early ones have converged into non-existence. But most recent, the one I left voluntarily about 20 years ago was Prudential Securities. And for almost all my career, except for the first 2 years, I basically, when I was working for brokerage firms, worked as a director of futures research. So there was, and before that it was Payne Weber, and before that Smith Barney. Those were the last three major firms that I worked for. Subsequent to that, I spent a few years starting my own little hedge fund, and that led to getting approached by a London hedge fund advisory group, which asked me to join as a partner, which I did. And I spent about 10 years with them until we got bought out by a London merchant bank called Close Brothers. And after that, I took some more time, wrote a few. And I wrote books all along my career. But after leaving that, I spent 2 years where I mainly wrote books. I wrote 3 books during that period. And then I got involved in the startup Fundseeder.com, which I guess we'll probably talk as a separate topic later on. And I also do one-off topics, as they tasks as they come up. And one was a syndicated project I did for TradeShark. So that's a 40-year career in 2 minutes. I guess that's as good as I can make it.
Yeah, that's excellent. And just before we move on, just one more point I'd like to touch on there. In your sort of research positions, what sort of tasks or what sort of things were you working on a day-to-day kind of basis?
You mean now or previously?
In your sort of research roles when you were working with these firms?
When I was a research director, basically, I was involved in both fundamental and technical analysis. I started out as a fundamental analyst. That was my first job. I didn't believe in technical analysis at all until I had a technical analyst work for me by the name of Stephen Kronowitz, and I noticed that he did pretty well in his calls. Actually, of all the analysts, he was one who did the best. And it may, being not like to believe that I'm not a closed-minded person, sort of, said, okay, tell me about what you're doing and how you do it. And sort of I got to better understand what the rationale behind technical analysis is, that it's not just a matter of trying to look at pictures and it's not a black magic art. It's really the philosophical concept behind technical analysis, nothing more than prices reflect the behavior of all the participants and so the influences on the market. So therefore, there is a logical reason to believe that charts might be helpful. In any case, he was my influence, and after spending up to that point maybe 5, 6, 7 years purely as a fundamental analyst, and discovering that fundamental analysis, while it works for some people, it never worked well for me, because even when you got the even when it was helpful and it gave you the basic idea of whether it's a bull or bear market, it did nothing for timing. I mean, that's one problem. Fundamental tells you nothing about timing. And the other problem is fundamentals sort of have how should I best put this, almost pathological relationship with risk management, in that if you have a fundamental opinion and the facts and the fundamentals don't change, the more wrong you are, the more the fundamentals dictate that you should increase your position, which is the exact antithesis of what you should do from risk management. Whereas, because to explain that a little more, let's say if I decide that wheat is a good buy at $5, if it goes down to $4, then it's a better buy, So if nothing has changed, right? So I should buy more. So the trouble with fundamental analysis, it has no risk management inherent in it, and on the contrary, it has the opposite of risk management. It would cause you to increase your position when you're losing. But technical analysis, by its very nature, if the market goes against you, unless you're one of those rare technical people who are using a counter trend approach, but with that exception, for the most part, virtually any methodology using technical analysis, if the market's going to go against you, the methodology itself would dictate you're getting out. So that was a big advantage as far as trading goes. And when I became familiar with technical analysis, I basically abandoned fundamental analysis as a way of trying to trade, and any trading I subsequently did was always technical oriented, whether it was discretionary chart reading or whether it was systematic, but it was always technical rather than fundamental.
Sure, okay. Thanks for expanding on that, Jack. Now, you've written over 10 books in the time frame of about 30 years. So it's clear you have an undeniable passion and a fascination for markets. But what was it that sparked this? And more so, what is it that continues to intrigue you about markets?
You mean an interest in markets, basically?
Essentially, yeah.
Well, when I got out of graduate school, I was basically looking for an analytical job that was not repetitive. And I guess you really can't get into anything more non-repetitive than markets because it's always changing. And so it was an interesting way to combine analysis and a subject of study that was always challenging and always changing. So I think that's what's interesting about it. It's also a place where your opinions are, you get your grades pretty instantaneously. I should be clear, though, and I know your podcast is really a trading podcast. I got to be honest, even though I am probably considered one of the experts, certainly in terms of picking the minds of traders and trading advice, and I do think that what I've written in terms of trading advice is very sound stuff, and I've had so many people tell me it's helped them that I kind of believe that it's true. But having said that, I myself do not really consider myself a trader. I'm not particularly talented as a trader. I don't particularly have any grand emotion or passion for trading itself. I do it, sometimes I don't. It's on and off thing. Sometimes I do it, sometimes I don't. I don't particularly like the emotionalism of trading, which is one of the reasons I don't do it all the time. And also, it's a time eater. If you're trading, then it keeps you from doing other things. And so, for time reasons, many, many times I don't trade. But for large parts of my adult life, I have traded. But it's never been a main thing. I've never considered myself a great trader. I can basically the most I'll say about myself is I'm net profitable, but I don't consider myself a particularly good trader. Although that has nothing to do with the stuff I write about, which comes from traders who are exceptional and whose advice I think is very sound.
Sure, yeah, well, that makes sense. So, let's talk a little bit about some of the books you've authored and some of the things you've learned and been able to extract from the minds of these insanely successful traders. So, first of all, what inspired you, or where'd the idea come from to write your very first book, a complete guide to the futures markets. I mean, what was it about?
Oh, it's very good. You're one of the rare interviewers that finishes that question with a complete guide to the futures markets. Usually the question is finished with Market Wizards, and I have to backstep and say, that really wasn't my first book. So the complete guide to the futures markets, it's going to sound egotistical when I say this, but when I got into the futures research, I kind of was impressed with the lack of quality stuff out there. And I didn't particularly think that I was great, but I thought that I could do better than anything that was out there. So I didn't find what I considered a really good book on the futures markets, and I thought that I could write a better one. And circumstances worked out that I was leaving a job, and I would have had no problem going and just finding another job. But I decided, I wanted to write this book. Why not take the time now? So I took a sabbatical. And so what I was trying to write was a comprehensive text on futures, sort of the definitive text on futures, at least for that time. And it was a serious work. So, I mean, it runs over 700 pages. It covers all sorts of stuff in fundamental analysis. It covers statistical stuff. It covers all sorts of classical chart analysis. It covers technical indicators. It covers trading systems, testing trading systems, trading. It's pretty comprehensive. So that's the book. And I did that again pre-PC days, pre-computer. I was literally, for those who do stats, you can appreciate this maybe, but I had to resort to doing multiple regressions using a calculator, which is just a great time waster. But it would have been a lot easier to do the book in modern times than it was when I did it. And it was only because I was so enormously focused at that time that I was able to even do it in a year. I also had to hand do the charts, everything. There was no Excel. There was no, or maybe I don't know if there was Excel or Word or any of those things existed, but this is 83, 84. If it existed, I didn't know about it, and I didn't have a PC, and I guess PCs were still probably in their infancy at that point. So in any case, that was a really a book that required manual labor. And that was the first book that I did. Now, having done that, I really didn't have a great eagerness to do another book quickly, but I did along the way, as I was involved in trading, and I knew some great traders like Michael Marcus and some other people. I was at that Commodities Corp actually for a year. I knew Bruce Kovner, and I knew some other people who were great traders. I thought, would be an interesting book to write, going to interview like these great traders and find out what they do and what do they do that's different, and why do they excel where so many fail. But I had a full-time job more than full-time job as a director of futures research, and I wasn't eager to sort of work nights and weekends additionally on a book. So I didn't do anything for a couple of years, even though I had the idea. And then one day I got invited by a publisher to have lunch, and they said, basically the pitch was, we think your Complete Guide's a great book. We'd like you to, we have this idea for a whole series of analytical books. We want to do one on each market, and we need an editor-in-chief, and we want you to head up the project. And sort of having done one of those very, very in-depth analytical books, which, by the way, you only do because you're trying to prove something, and you're trying to prove that you can do a really good book, or just for ego almost, or for self-satisfaction, or to demonstrate, or to just achieve putting out a really good book. But you certainly don't care, or you're certainly not focused on selling because, and I say this only semi-facetiously, it really is true as well, that the amount of books you sell are inversely proportional to the number of equations you put in a book. And by virtue, and I knew I put more equations in than I should put into that book if I wanted to sell a lot of copies. So maximizing sales was never my goal on the complete guide. It was basically to the best book I could that was serious and analytical and could be read by a serious layman. I think it doesn't require really a college degree in math or science necessarily to understand, but you have to be serious. That I only wanted to do once, and the last thing I wanted to do was to do it again. So I said, I'm not really interested in that project, but, because I don't want to do a bunch of books that sell very few copies and require a lot of in-depth work. So I said, I have this idea, which is I viewed more as a mass audience book and more of a book that, could reach, just a broader audience and be more entertaining to read and so forth. And I told them about the market wizard concept, and they really liked it. So I wasn't intending to do the book, but they came back with an offer, and sort of that was the catalyst. And that's how Market Wizards got written the first time.
Okay, that's really interesting. It's good to sort of know where the idea for that book came from. And I'd like to quote the opening line from the new Market Wizards, which is the second one in the series, where you said, "The markets are not random." And you made it very clear that this is a statement that you truly believe. But to what extent are the markets not random?
Well, to the extent that they're not random in a couple of ways. And this goes into the whole controversy, which has been going on for decades, between those who believe in the efficient market hypothesis and those who don't. The latter being, at least in serious academia, being behavioral economists. But of course, originally and now as well, the whole sorts of people in a trading community. Now, I felt from the beginning that concept was wrong for many reasons, but two big conceptual reasons. One is I just knew too many people who had obvious trading skill. And it wasn't just they were lucky, they just did too many trades for too long and had results that were too lopsided to be explained in a probabilistic sense that, if you have enough traders, some will get those results. No, I don't care how many, you can have 10 billion traders, you're not going to get those results, So clearly something is going on here where people are getting types of track records that from a simple probability calculation would be impossible if the markets were random. And that's one of the arguments I always have against the efficient market hypothesis. The second thing is, and this big, in both of these are big areas and there's kind of sub parts to them, but the second big concept of why I think people are wrong when they believe the markets are efficient is because prices, very often there's circumstances where clearly the market price is not right. I mean, there's just tons of examples where you can show that to be the case, and there's by no stretch of the imagination can you say the market price is right. So I'll give you. In fact, I wrote a book. My next to last book, and it was a non-market wizard book called Market Sense and Nonsense. And in Market Sense and Nonsense, which I go through a whole bunch of. Each chapter deals with a different set of, different subject of misconceptions. One long chapter, probably I think the longest chapter in the book is debunking the efficient market hypothesis. And one of the things I do in there is I give a number of examples of just come on, in no sane world could this happen if the markets were efficient. And there's a lot of examples. So let's just go, let me take one. I mean, there's so many. So let's say take something like Countrywide. Countrywide, if you had to pick a company that was the worst of the worst, I mean, I don't know who I would pick, this whole 2008 financial meltdown and companies that participated, in my mind, the heads of these companies should have ended up in jail, but they walked away with hundreds of millions of dollars, unfortunately. But no one was worse than Countrywide. And Countrywide literally proved everything. You could not, their people were instructed to give mortgages. If they turned down a mortgage for any reason, like just because a person didn't have a job or income or anything else and was asking for a large amount of money, they would be told to find a way to do it. And that was because Countrywide then sold off they didn't have to keep it. They didn't have to worry about people repaying. They sold it off to Wall Street, who didn't care because they repackaged them and sold them off to investors who didn't know any better. Or I should say, not who didn't know any better, who were relying on the rating agencies, who were either themselves incredibly dumb or compromised and looked the other way and then therefore are guilty in that sense. But they can only plead either stupidity or malfeasance. There's really no other way of explaining it. But in any case, going back to the origin type of company, the ones who produced these really, truly terrible mortgages that just had a very, very poor chance of being repaid, and did so knowingly and had a corporate culture where negligence was encouraged. Nobody, I think, could be worse than Countrywide. And that now, I just try to get people a sense of how bad this company was. So now a company like Countrywide was depending totally on this housing bubble going on. Because as long as the housing bubble goes on, prices are going up, and no matter how incapable people are of paying back a mortgage that you give the mortgage to, as long as housing prices go up more than they have to pay back, it kind of sort of self-sustains. Yet if that stops, a company like Countrywide is going to be in a whole bunch of trouble, right? Not only did it stop, but you can look at something like delinquencies. And delinquencies were sort of, during the housing bubble, were very low at about 5%. And then they start going up, and they go up and they go up, and they went from 5% to 10%. So mortgage delinquencies actually doubled. Now, this should have been like, mortgage delinquencies going up is the type of thing that should be a screaming cautionary note, for Countrywide being subject to collapse. And if you look at the chart, and this is why I say, if you tell me the market price is right, you got to be just blind. And I'm just mentioning, I'm going through detail in one example, but there's tons of cases like this. So what did Countrywide stock do? As delinquencies went double from 5 to 10%, it actually went up to a new record high. The record high occurred after delinquencies has doubled, and about a month after the record high, the stock collapsed. It didn't stop collapsing until until the company went out of business. So how could you can't explain that by the market price being right? No, what was going on was there was a bubble. People were just buying. People were buying without real insight. And there was enough dumb money that was willing to go into the stock because it was making new highs, even though it was completely rotten to the core. And the thing that was vulnerable was already blasted out because these are reported statistics. Mortgage delinquencies are reported data. So it's no big surprise. And so the collapse of the stock occurred about a year and a half after it should have. And it occurred right after it made a new high. So that's one kind of example. So my point here is that market prices are not always right. And if market prices can be dead wrong, and you can show many examples where they are, then the idea that underlies the efficient market hypothesis, that market prices are always right and all new information is immediately discounted, doesn't hold water because if market prices are not right, the whole theory falls apart. The one place the efficient market hypothesis is correct, and the reason why there's an illusion that it's correct, is because one of the conclusions that come out of the efficient market hypothesis is that the markets would be very difficult to beat. And that is true. The markets are indeed very difficult to beat, but not because the markets are efficient. They're very difficult to beat because what moves markets are both fundamentals and human emotion. And human emotion is very difficult to gauge. I mean, how far does a bubble go? When does the bubble break? These things are very hard to predict and very hard to trade. So it's not because the markets are efficient that the markets are difficult to beat. It's because there's such a big influence of human emotion that can't really be programmed to exist precisely and is very difficult to gauge. And so there's this conclusion by people who look at the market and say, oh, the mutual fund managers always, usually lose to the indexes and markets are really difficult to beat. Therefore, the market are efficient. Well, no, that's not why they're efficient. Yes, markets are difficult to beat, but that does not mean they're efficient. In fact, one of the things I put into Market Sense and Nonsense was that line of thinking actually, it violates a basic rule of logic. So there's a rule of logic that says the converse of a true statement is not necessarily true. So let me explain that with a simple analogy. A true statement is all polar bears are white mammals. That's a true statement. All polar bears are white mammals. However, flip it around, all white mammals are not polar bears. The converse is not true. Like you could have a snowshoe hare. So the thinking that because something is true, if A is true, then B is true, then going to say that B is true, therefore A is true, that's a flaw in logic. And it's done all the time by many people who are arguing the efficient market hypothesis. It's just a straight out flaw in logic. And so what they're saying is, if the markets are efficient, then the markets will be difficult to beat, and then give you all these examples of how the markets are difficult to beat, which I totally agree. Yes, the markets are extremely difficult to beat. And then they jump from that back to the markets are efficient. It's a flaw in logic. And I can go on, but I think I've killed it. Oh, there's one, I got to throw out one, which is it's one example which is so beautiful. It's a recent one I came across, and I went to see Richard Thaler, who's one of the pioneers, and maybe the pioneer of behavioral economics, and a long time disbeliever in the efficient market hypothesis. And he threw out this one example, which I just thought was brilliant. There's a closed-end mutual fund that has the ticker symbol CUBA, Cuba. Now, what it does is it has a portfolio of stocks that are invested in Latin America, South America, not Cuba, by the way, but it does have that because I guess it's a catchy symbol, CUBA. So that's what the closed-end mutual fund is. And like most closed-end mutual funds, it was trading at about, it was trading at a discount. In this case, it was trading at about a 15% discount. Which means that since closed-end fund, you can't do it. But if you were able to liquidate the entire portfolio, you're paying 85 cents on the dollar for what the portfolio is worth. That was on as of a given day. The next day, it goes from a 15% discount to a 70% premium. Okay, in one day. This is like unbelievable. So what happened? What happened is President Obama indicated his normalized relationships with Cuba. Now, the wonderful thing about this example is they did not hold, first of all, it'd be illegal to hold any Cuban stocks, and they didn't hold any Cuban stock, companies or stocks or whatever. And secondly, there was nothing in Cuba to own. It didn't even exist. Cuba is a true communist country, and there are no stocks to own. So despite the fact there was nothing Cuban in the whole portfolio, it went from a 15% discount to a 70% premium in one day because President Obama took steps to normalize relations with Cuba. You can't make this stuff up. And yet there are people who argue the markets are efficient, to which I would say, give me a break.
All right. Well, thanks a lot for going into so much depth with that answer, Jack. That's really good.
Are you ready to get serious about options trading? Then join Tasty Trade, Investopedia's best platform for options trading 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including a $10 cap per leg on options trades, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, and more features to help you trade smarter. Manage your positions with speed and precision using Active Trader Mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Join Tasty Trade today and earn a double commission rebate up to $3,000 total on your stock and ETF option trades for 30 days. Visit tastytrade.com/chat for more info. All applicable regulatory exchange and clearing fees still apply. Options involves risk and are not suitable for all investors. Learn more about Tasty Trade promo terms and conditions at tastytrade.com/double. Offer expires May 31st, 2026. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
So I'd like to sort of pull this back a little bit to maybe some of the really key lessons and things that you've learned over the years from speaking to the traders that you've interviewed for Market Wizards. So let me ask you, in the first two Market Wizard books, is there a noticeable change in trading styles of those featured in hedge fund Market Wizards?
No, actually, I don't think that's really much. There's not much of a distinction in that. Now, hedge fund Market Wizards came, I guess, at least almost 25 years, I should say, after maybe the first Market Wizards book. So it came much later, but it does include people who were around from much earlier. For example, in fact, it includes, of all the Market Wizard books, the fellow with the longest track record and the earliest, maybe the earliest trader of anybody I interviewed was Ed Thorpe. And he was in the Market Wizards, hedge fund Market Wizards. So although, of course, some of the people, if they're younger in hedge fund Market Wizards, then they are starting in a later era. But I don't think there's really that much of a difference. The only difference is perhaps that in the very first Market Wizards book, and maybe a little bit in the second, there is a larger preponderance of futures traders, perhaps, because, and I mean by straight out sort of futures traders, as opposed to people using futures for more complex strategies. And that's simply because back in that day, those were the traders that really excelled, and there were great opportunities in futures, and things like trend following worked much better back in those days before people started using the approach a lot. And the early practitioners of system trading, like Ed Sekoda, had these spectacular type of results, which I don't think you could duplicate nowadays. So that's, I guess, one difference between the early books and the latter books. But like in both in the early books and in the latter books, you had fundamental traders, you had technical traders, you had people who did both. You had system traders, you had discretionary traders, and you also had a large variety of approaches in any of the books. So I don't think there's a big demarcation really that one can draw from the early books versus the later books. And I should add on that one point. When the 25th year anniversary came up on the original Market Wizards, the publisher asked me to we want to do a new edition. So what I did is I actually wrote an additional chapter. So the volume that came out, I think, was the Market Wizards that was re-released in 2012, has an extra chapter. And in that extra chapter, what I basically do is I go back and I say, what do I believe now about markets? And I have one chapter about all the key points. And I deliberately did not reread the original Market Wizards when I did it. But the point was that I thought that my views or my conclusions about what are the important elements of trading success really didn't change from when the first book was written. So that chapter really was probably more intended to make the point that not much has changed when you get down to the important facts.
Okay, sure. And just to elaborate on that, and you kind of touched on it there, as we're now in 2015, do you believe that the same opportunity still exists in today's markets as it did for traders featured in the original Market Wizards? Like, besides their trading approach, is there the same opportunity provided by the markets, or has it become much harder to succeed at trading?
I would say from a logical standpoint, and of course one would have to give you a correct or absolute answer, you would need data from back then and data from now, neither of which I have. And I don't know of any studies that have ever been done on that. And I assume in all cases, the majority of people, well, by definition, the majority of people lose, but whoever the majority is larger now than then. I don't know of any data that would allow that to be answered. However, from a logical standpoint, I would say I would be surprised if it was not more difficult today than it was then, for the simple reason that you have many, many more professionals in the market than you did then. And I think there's a certain amount of opportunity in the markets, and the smaller proportion of professionals, and by professionals, it doesn't have to mean people working for Wall Street firms. It simply means people who are dedicated to trading and are really good at it and make a living from it. But the larger the percentage of, and of course, those are the people who have skill in the markets, obviously, by definition. But the larger the proportion of those people versus the whole population of traders, the more difficult it becomes to trade. And in fact, I'm sure I have a line somewhere in one of my books, I don't remember where, or maybe I just use it in talks, I don't know. But the line is something like, you could take the 100 best traders in the world, whoever they might be, and you could say, okay, you could have this thought exercise and say, if those 100 traders were the only traders that were allowed to trade the markets, the one prediction I could make is that 80% of them would lose, roughly speaking. And that's simply because if they were the only ones that are trading, we know that there's certain transaction costs involved in trading. So the amount of money that's won has to be less than the amount of money that's lost. So if only the professional traders or the most skilled traders in the world could trade, by definition, a majority of them would have to lose. And that just makes the point very starkly. So it's obvious that if you go from a small proportion of traders as part of the trading population to a larger proportion, you get to a point where it becomes almost inevitable that even professional traders lose. So therefore, it is safe to conclude that the greater that proportion, the more difficult it is to beat the markets. And I certainly think there's a much larger percentage of professional traders today than there was, say, 30 years ago.
Yeah, okay. I mean, that's a really interesting concept and way of looking at it. So thanks for sharing that with us. I'd like to bring up the topic of failure, because this seems to be a common theme amongst many of the traders you've interviewed, where they have experienced failure in one way or another, and in some cases multiple times before actually sort of making it, so to say. So what's perhaps one of the most extreme cases of failure and recovery that comes to mind?
Wow, there's quite a few of them. There's a number of traders who blew up or nearly blew up, some who blew up multiple times in the Market Wizard books. I'm glad you picked that up, because that is a common occurrence, and from which I draw two conclusions before I go to some examples. But let me give you, the listeners, the two conclusions that I get out of that. One is that early failure, or even terrible failure, is not necessarily predictive of future outcome. It doesn't mean if you fail you're going to succeed either, but it does mean that if you have enough confidence, and just because you failed doesn't mean you're doomed to fail. There's plenty of people that I've interviewed who were disastrous in the early years and turned out incredible. That's point one. And the second point is, well, they did ultimately succeed because they didn't give up. So that is an element of excelling, is this spirit or the self-confidence that just doesn't give up. Now, as far as examples, I could give quite a number, but let's just take one. Michael Marcus, who I mentioned earlier, who was the trader whose job I took when he left to become a trader, and who became a phenomenal trader. But his early experiences in the markets, he sort of lost, he had a very little money to start out, lost that, then cashed in his father's the life insurance. His father, who died at an early age, had left. It wasn't much, it was like $3,000 or whatever, but he lost that. And then he started trading and some more money, and then he kind of hit it, and he built up this small few $1,000 stake into 30,000. And I go through a whole story in the book. I won't go through it here. But he then borrowed some more money from his mother, who was, of not of very good means, barely got by. But he got so caught that he actually then lost all the money he had made, plus a part of her money. So that was his experience, and very few people would have kept on going beyond that. He did, though. And the way that story ends is he eventually did learn how to trade. He did get extremely, extremely good. He was talented. And he ended up going to Commodities Corp. They gave him a $30,000 account as a starting portfolio. And he eventually built that $30,000 account into $80 million over a dozen years. And he did that while they were taking out 20% of his profits annually for expenses. So one of the probably most successful traders of all time. And hard to find anybody who had a more disastrous beginning.
Yeah, that's an incredible story. That's really, really impressive. So let me ask you this. Do you believe that perhaps some of the traders you interviewed almost had some type of natural talent for trading? I mean, I don't know if that's the right word. Or would you say that it really is an even playing field and anyone could reach these insanely high levels of success with enough hard work and the right people around them?
Yeah, no, I would say with fairly strong confidence that not everyone could. For the same reason is not everyone's going to be able to, I don't care how hard you train, you're not going to run a professional marathon time, because most people don't have the body type that will make it possible. Now, can people run a marathon if they've never trained before? Yeah, if you're gonna train hard enough, you can eventually run a marathon successfully, maybe even at a decent time, but only a tiny percentage of people will ever run it at a world-class time. And that's just the way most people's bodies are not constructed to make that possible. Can most people become soloists with the New York Philharmonic, if they take up the violin and practice a lot? No, I don't care how much they practice. They may become competent. They may even become, good, but very, very few people will become world-class violinists just because it requires some sort of innate skill besides just dedication. But in all those cases, people can achieve proficiency and success, but not necessarily exceptional success. And that's what I'm saying. And I think the same, why should trading be any different? So I think people can become net profitable, maybe even decent traders, if they have enough devotion and if they have some skill, more than decent traders, but only a small percentage of people, I believe, have the innate makeup, whatever that may be, to become truly exceptional. And I don't think trading is different than any other profession in that regard.
Okay, sure. That's a really good point you make. So, I mean, it's obvious that all the traders you've interviewed over the years were doing extremely well. But even still, did you find that they were constantly looking for ways to improve their trading? Or did any of them ever strike you as having felt like they'd perhaps mastered the market and were really comfortable with their approach?
Well, I think they were comfortable with their approach, but I think most would always be looking or realistic about if things stop working to change. And there are some people who are pretty exceptional at going from one strategy to the other. Ed Thorpe is a great example, who started out by actually. His background is he had a PhD. We didn't get the PhD in physics because he never finished his thesis, but the reason he didn't finish because he decided he didn't know enough math and then ended up with a PhD in math and then never wrote his thesis in physics. So he was a real quant guy, but he got involved eventually in markets. He's famous. His fame in the world, by the way, is not markets. His famous to the world because he wrote this book, Beat the Dealer. He figured out mathematically how you could win a blackjack, and he wrote this book that sold millions of copies. And and actually is the person who's responsible for casinos changing the way they handle blackjack, multiple decks, reshuffling all of that, due to his book. But that's sort of a tangent. To go back to the markets, he decided the real place to make money was the markets. And he was the first one to figure out the mathematical equivalent of the Black-Scholes model, which he did quite a few years before the Black and Scholes published their famous paper. So for a number of years, he was trading options very successfully, probably the only person in the world who knew how to price them. So he was making massive amount of money with very, very, almost no drawdowns. Then he went on, but as the efficiency went out of that, he became involved in statistical arbitrage. He developed that. He developed convertible arbitrage. He developed various strategies going from one to the other as each strategy started to lose its edge as more people became familiar with the approach. So he's a perfect example of somebody who starts out with one strategy and goes through completely different strategies by adapting to the changing market conditions. Even within a single strategy, like statistical arbitrage, I'm not going to go into the details because it's too specific for this type of broadcast, but even within that strategy, he changed the way that strategy worked through several iterations as the markets were changing, each time making the strategy again have an edge. And that's in the interview. I think it's too detailed to go into in this podcast how he did that.
Yeah, and I mean that kind of raises a point which I've heard you talk about numerous times, and that is that most traders tend to come unstuck due to a lack of flexibility. Is that what you're getting at here?
Yeah, I mean that's a trait that probably the majority of traders don't have, and it is a trait that is essential for great traders. That is the ability to be flexible in every way. And one example would be to be able to say, hey, this has been a great method, but it's just stopping working, and I've got to figure out what does work and why this is not working and change if it's not working. So that's a way of being flexible. Another way of being flexible is like one of the stories I have in Hedge Fund Market Wizards, a fellow by the name of Jamie May, who goes into a trade, goes into one trade idea, and this is a guy who does very, very deep fundamental research and can spend months researching an idea and making sure he's got it all right. But he had this idea, say, a few years ago where China was going from being a net exporter of coal to a net importer after years, a whole history of being just a net exporter. And he saw this growth in China and could see that there was going to be a tremendous amount of shipping increases going on because of China's demand. And so he had this bright idea of getting long shipping stocks. But when he did the research, he discovered that that shipping had actually gone through a boom a couple of years earlier because of a commodity price boom, and there was a whole slew of ships that were coming on stream, tremendous bulge in supply that was coming on stream. So once he became a bit aware of that, he realized that the trade was not buying shipping companies, but being short. He doesn't actually go short because he's always trying to have asymmetric return risk, so he did that by buying long-term puts on shipping companies. And ironically, this big idea that he had, which he put on in exactly the reverse fashion, ended up being his best trade for the year. Again, flexibility. And of course, maybe the most important way of being flexible is when you're in a position and you decide that you're wrong. It's the ability to get out. And if you're really convinced you're wrong, great traders will not only get out, but will have no problem flipping their position completely around.
Yeah, okay. And I think this is probably a good segue into my next question, which is, are there any traders you've interviewed and that stand out who pretty much just broke all the rules and just did the complete opposite of what you're quote-unquote supposed to do when it comes to trading?
One. You can take all the traders I ever viewed into my life, successful traders I interviewed in my life, in any of the books, and including ones I interviewed that didn't go into the books, but only one stands completely alone, completely removed from the whole crowd of other traders. And there is, to use a cliche, the exception that proves the rule, I don't know. But the fellow is a prop trader, stock trader by the name of Jimmy Baladimas. He is the last chapter of hedge fund market wizards. Now, I should explain how I found, well, let me tell you what Baldemus does. You remember like a couple of years ago where we had certain commodities going sort of vertical, like silver, which had been going straight up, and then they got to 30 and 40s and even I think low 50s. But if you remember what that move was when it was almost like going straight up vertically in those higher price levels, well, who is selling silver in that type of a market? Jimmy Baldemus. Or cotton, which had gone multiples of its prior record highs, with the last days of the rally being these straight up, like a cliff type of huge price moves. Who's selling that market? In that vertical ascent? That's Jimmy Baldemus. So he's taking trades where the markets are going berserk the other way, and he's stepping in and going short. That's the type of trading he does. Now, I kind of say my first line of that chapter was Jimmy Baldemus breaks all the rules. And one of my first lines in the concluding paragraph, concluding summary of that chapter is some variation of "don't try this at home." I mean, my point, I really don't want people to read that chapter and try to trade like Baldemus. And I do draw some aspects of his trading that do have applicability, but it's actually one particular aspect. But I want to make clear that I really don't want people to, by any stretch of imagination, think that this is something they should try. Because 999 out of 1,000 people will go broke doing this. By the way, if I was listening to this myself, and I heard somebody saying what I'm saying, said, "No, that can't be right. This guy couldn't be successful doing that. He's, these numbers can't be right, and he's going to blow up." Well, I don't know. I guess he theoretically could blow up, but as far as not being right, he's been sort of one of the best traders in his firm now for many, 15 years plus. And the way I know. And he makes millions every year, or I guess maybe in a bad year he comes closer to breaking even. But he's made a large amount of money trading this way. And for those who are skeptical, wonder how can I believe this is true, particularly for a prop trader. And people who are familiar with prop firms know you can't get track records from a prop firm. There's just no way of doing it because they just won't give out their numbers. So how do I know that this is for real and he wasn't like pulling a fast one on me? My son got a job as his trading assistant. And one day speaking to him, he said, "Dad, you wouldn't believe this guy I'm working for." And of course, being in the company, knowing of his reputation, he knew, and he entered all his trades and he knew his numbers. And so he knew he was for real. And that's the only reason I was able to put that chapter in the book, because otherwise I would have said, "No, this can't be right. This guy this can't be true." I would not have believed it myself. But if I didn't have my own son for verification, I wouldn't have believed it either. So, but for those who are wondering how that could possibly be true, that's the answer.
Yeah, and I guess that kind of, even though you said don't try this at home, obviously for good reasons, I guess it kind of highlights a point I've heard you make in sort of given talks and other interviews about how it's so important to find your own trading method and not necessarily try and mimic exactly what someone else is doing.
Absolutely. Yeah, and that's actually, when I give talks myself, if there's any point I emphasize probably more than anything else, is what you just said, that don't look for the trading secret. There is no trading secret. Look for the trading method that's right for you, and it's not going to be the same for everybody. So that's absolutely true. And then Baldemus's approach would be wrong for almost everybody. It's right for him because his nature is he just is not happy unless he's going against the crowd. He just always wants to be against the crowd. And if he tried trading another way, he probably wouldn't succeed because it's so against his nature. It's not a good way. He actually could. And in the interview, if people read that particular interview, they'll see I'm trying to say, hey, by the way, the reason he makes money trading against the markets that way is not because he necessarily is great at picking tops and bottoms. It's because he's constantly trading against his position. So he's going short, the market comes back a little bit, he's buying it back. when he's buying, he would do like 300, 400, 500 trades a day, and he could be short like 500 stocks. But if some of them, whenever he's short, if they dip a bit, he'll take partial or total profits and then put them back on. So he's constantly taking profits out of the market that way. So that's what's really making his money. And he succeeds even though he's against going to major trends. It seemed clear to me that if he did the exact same thing, just trading against the positions, but went with the trend instead of against the trend, he would be a lot better off. And I explicitly mentioned he never really argued it or could give any reason why that wouldn't be true, but it was just against his nature. He just had to be opposite the wave in the market. If there was a mania of any sort, he had to be against it.
Okay, sure. So, I mean, while we're on the topic of trading methods, I mean, you often hear people say, keep it simple, don't overcomplicate things, simple works best. So my question is, did you notice amongst any of the traders you've spoken with and who were doing extremely well in the scheme of things, that for the most part, they do have a very simple approach, or is there an aspect of complexity to their success?
I've seen both. That's a type of trade or factor that doesn't really, there is no proper one for this. Is a successful traders use simpler approaches, successful traders use complicated, but I've seen both. Again, going to something like Thorpe, his approaches were highly quantitative, highly complex, and it was their complexity, I believe, that not just the complexity for the sake of complexity, but complexity that was necessary. Well, so let me say that again: complexity that was necessary to tease out the edge that he found. Or people like D. Shaw, again, extremely complex approach. I mean, you're talking about trading virtually every market in the world, all sorts of derivatives, outright markets, all sorts of options, thousands and thousands of instruments, trading them all against each other with scores of models, with teams of hundreds of PhDs. Yeah, I mean, you really can't get much more complicated. And it's the complexity. He's teasing out small. He's not actually actively participating anymore. He went off to pursue other endeavors, particularly computational biochemistry. But he designed this whole process, and he was basically finding a lot of very, very small edges, or that's what the approach does. And it would not succeed without complexity. So you have that as clear. You have those examples for clear situations where you couldn't really be successful without that necessary complexity. On the other hand, you have other traders who are not doing anything much more complicated than reading charts, but are particularly good at it, and use risk management and basically combine chart pattern recognition with risk management. Doesn't require a PhD. It does require a skill to be able to tell which patterns are more likely to result in a move one way or the other, and it does require the skill to use the appropriate risk management. But having those two properties, it can then be executed without really any great complexity. So I think it ranges across the board.
Yeah, and I mean, I guess that just sort of comes back again and highlights your point about finding a trading method that that meshes with your personality. Now, something that is forever embedded into my memory after reading, especially the New Market Wizards, was the necessity of having an edge. So I'm interested to get your take on this. What exactly is an edge? Like, how do you define it, and how do you know if you have one?
So first of all, there are people who misleadingly think that an edge is not absolutely necessary if you have good enough money management. There's in fact, there's a famous Wall Street saying that goes something like, even a poor system could make money with good money management. Now, that's absolutely one of the most ridiculous things that has ever been said. Besides not being true, it's just absolutely stupid. And the reasons it's stupid is for the same reason it would be stupid to think that you could go to Las Vegas and play roulette with a money management scheme and come out ahead. No, you can't come out ahead. because the house has the edge, you have a negative edge. All you're going to do if you try to apply money management is to guarantee that you lose. In fact, actually, money management in a situation like that would be bet all your money one time, because that's your highest probability of winning. So the best money management scheme is real betting it all at once, which is really the opposite of money management. So you can't be salvaged by money management. Now, the money management is absolutely essential, maybe more important than methodology, but it's not enough. You need to have an edge. So this gets down to, okay, so how do you know if you have an edge? Well, it's not one of those things you can look up or find a rule or prove absolutely. I guess you could see it in your equity if you show some consistency of making money without unduly large drawdowns. Then over time you can begin to conclude that you have an edge. If you are good at the markets, people who are good at the markets, another trait that does typify really good traders is they have a high level of confidence.